Okay, welcome everyone. Welcome to those who've just joined since I first spoke. My name's Fiona, and really great to have you all in the workshop today. I think we'll have some attendees still joining us, but I think in the interest of time, with lots to cover today, we'll get started. So a big welcome to you all to this half day of training on the IFRS Sustainability Disclosure Standards. So this program is a really collaborative effort driven by that demand we're seeing for more information and training to support the implementation of sustainability reporting globally. So firstly, just to say a big thank you to our partners in this program, the IFRS Foundation, the IFC, and of course the Somali Stock Exchange for hosting us together with you all today. And of course, a big thank you to all of you for taking the time out to join us in the training. So to get us started, I'm very pleased to say that we have an opening speaker joining us from the exchange. So a big thank you to Hamdi Osman, the Events and Communications Manager at the Somali Stock Exchange, for hosting us today and offering to provide this opening. So many thanks, Hamdi, and the floor is yours.
Hello, everyone. My name is Hamdi Omar Isman, and I'm the Events and the Communications Manager at the Somali Stock Exchange. First, I would like to thank the IFRS, the UNSSE, and the IFC teams for their support and collaborations. Welcome to this vital training session on IFRS Sustainability Disclosure Standards, organized by Somali Stock Exchange in partnership with the United Nations Sustainable Stock Exchange, IFRS Foundation, and International Financial Corporation. Today, we gathered to explore the critical topic on sustainability disclosure, which play an essential role to enhance transparency and accountability in our capital markets. As we face global challenges related to climate change, social equity, and corporate governance, understanding these standards is more important than ever. This pre-training session is designed to engage listed companies and professionals across Somalia, providing you with the opportunity to interact directly with the experts from the IFRS foundations, the UNSSE, and the IFC. And their insights will be invaluable as we work together to implement these standards in our organizations. I encourage each one of you to be active participants today, ask questions and share thoughts, and take also full advantage of this unique opportunity to enhance your sustainability, your understanding, or your sustainability practice. As we embark on this journey, let us commit to sharing this knowledge with our colleagues and networks so we can enhance our organizational sustainability or our organizational resiliency and contribute to sustainable future for Somalia. Thank you for being here, and I look forward to a sustainable or to a productive session. Thank you, Fiona, for giving me this chance.
Perfect. Thank you so much, Hamdi, for that welcome. And yeah, fantastic to be partnering together with your exchange on this topic. Brilliant. Thanks so much. So we'll now move into a little bit of an overview of some practical points for today's session, as well as an overview on the agenda of what we're going to cover in the training. So firstly, just for housekeeping, you will have noted by now that as participants, you're muted. However, we do really want to encourage you to make use of the Q&A and the chat functions to engage in the session and share your thoughts. So if you have any general comments or you'd like to make introductions as you're doing currently, please use the chat box. And then if you have any questions for the team, make sure you're putting those in the Q&A box in particular that you also have on your screen. And that just allows us to track and respond to those questions for you. Then in terms of our format today, so as you're probably aware, we have a live 3.5 hour training session together, and we do have an optional follow-on homework activity that you can take part in as well if you'd like to continue your learning. And as I've already mentioned, there'll be live opportunities to ask your questions in the Q&A, so make sure to do that. And you can also upvote other people's questions with a thumbs up if you'd like to make sure that a question gets prioritized to be answered as well. We do encourage and kind of expect your participation in the session. So we'll be using a number of interaction tools throughout, including the Zoom polls and Menti exercises as well. So please do take part in those. And finally, for taking part, you will be able to receive a completion certificate. So we'll share the instructions about how you can get your certificate at the end of the session by completing the survey that we'll send you at the end of the session. Okay, so just to say who will be delivering the training today. So I'm Fiona, as I've said, I'm within the SSE Academy team at UN Sustainable Stock Exchanges, and I'm joined by my colleague, our senior specialist, Lois Guthrie. And alongside us, we're very pleased to be joined by our colleagues from the IFRS Foundation's Capacity Building Programme. So firstly, Robert, and secondly, Vanessa, who will be supporting us in delivering the training today as well. So in terms of what we're aiming to cover with you today, we've got 3 key learning objectives. So firstly, we'd like to help you to understand the ISSB standards. Secondly, to think about how you can use the ISSB standards. And then finally, to identify the steps that you need to take to develop a disclosure plan to allow you to apply those reporting standards. So we've broken that kind of set of learning objectives down into a 4-step agenda that I'll just talk you through now. So we'll come back to this structure throughout the programme. So hopefully we'll help you to understand where you're up to in the training content as well. So our first module, Prepare, is all around understanding reporting. So thinking about what the purpose of it is, what the landscape is for different reporting standards, and how we've developed the global baseline of the ISSB standards. We'll then move into Align, which is all around setting the direction for your reporting. So thinking about how you can apply and use the IFRS standards and what additional disclosures you might need to add to meet your regional requirements as well. We'll then move into Implement, which is all around thinking about the practices and systems that you're going to need to put in place internally to support you in this topic. And then finally, we'll finish with Communicate. So that's thinking about the final format of your reporting. So thinking about its location, how to do so efficiently, and how to ensure user confidence in the disclosures that you're providing. And then just to show that as an agenda in terms of how our timings break down today, we'll split the modules across the session. We'll take a short break in the middle as well, just to refresh ourselves. And just to note, module 2 line is where a lot of the content is. So we'll be well more than halfway through the training once we've completed the first 2 modules, just to confirm. And we'll finish up, as I said, with a bit of an overview of the homework assignment and some additional resources that you may like to take away to support you as well. And as a reminder in that regard, so all of the content that we're going to be talking about today from the UN SSE perspective is available on the event page for this session. So Lois has already shared with you the link in the chat where you can download this content. So if you go to that page, you'll find the homework assignment that I've mentioned, and also the slide presentation from today's session is available for you there. And Lois has just reshared that link again now. So if you go there, you'll get the slides with all the links to the resources that we're discussing and sharing with you. And we will also add the recording for the session to that page after we've completed as well. And as I've just mentioned there, the homework assignment is another aspect that you can take away. So the aim of the homework is to help you to develop your disclosure plan for your company, to put into practice what you've learnt in the training and help you take this forward in your organisations. So it isn't mandatory to do the homework and you don't have to submit this to us, but you can follow the link that Lois has shared if you'd like to take a look at that to help you to continue your learning and take this forward with your colleagues. And then just to mention a few of the guidance resources that you have available from the SSE that we'll draw from in today's training. So you can follow the QR code there to look at these resources, and they'll also be available at that web page link in the slide handout that Lois has shared. But we have a number of tools to support you on this topic, and in particular, I'd highlight our model guidance on sustainability related financial disclosures, which is designed to align to the IFRS standards and support your adoption journey. Okay, so to get us started in terms of the content, we wanted to have a quick Menti exercise to get you used to using Menti, which is, as I said, we'll come back to a few times during the session. So if you follow the link that Lois will shortly be sharing with you in the chat, that will take you to our first Menti question, which is just to get a sense from everyone on what you're hoping to get from today's session. So that link should be coming through to you shortly, and I'll just share my screen now to show you Menti as well, because that gives you another couple of options for how you can join us. So firstly, you can follow that QR code as well that you can see on the screen there if you'd like to go to Menti that way. And you can also go to menti.com. If you see the top of the screen there, you've got a code, an 8-digit code that you could enter at menti.com. Probably your quickest option is to use that link that Lois has shared in the chat, which will take you right through to this first question. So, as I said, the first question is just to share a few words with us around what you're here for today and what you're hoping to get out of the training session. Okay, great. I've seen our first respondent has accessed the question, so that's great. And I'm seeing learning, curiosity, improvement. So that's great. We'll give it a second for a few more of you to find your way in and let us know what you think. Just any words that come to mind as well. So don't worry, there's no wrong or right answers in Menti. So just share whatever's in your mind. And I see someone's mentioned in the chat about learning as well, to learn. Excellent. Experience sharing, looking at what's new, new knowledge, development, initiating improvement. Fantastic. Okay, lots of things that I think we'll be able to help you tackle as well. And someone's mentioned their career development as well. So fantastic. All very good reasons for being here. And I think hopefully we can help you in these areas today. And then I'll move into our second opening question we have for you, which is just to get a sense on what your existing comfort and knowledge is of the different tasks we're looking to understand today. So you should have a sliding scale where you can select from the left-hand side, maybe being very new to the topic and not comfortable, to being quite familiar with the subject already on the right-hand side. So you can use the scale to let us know where you're currently at with explaining the ISSB to your colleagues, to using the standards and developing a sustainability reporting strategy. Okay, I see one person's responded. I'll give it a little bit longer for a few more to take part. As I said, we really do encourage you to use Menti. It's a great tool. We'll use it for a number of exercises to help you reflect and learn from what we're talking about in the session. So encourage you to access Menti now, as we'll come back to it again later in the session again. Okay, but I see from those who've responded, probably overall not feeling too confident so far in these topics, which is no problem, of course. We're all here to learn together, but maybe feeling most confident about the sustainability reporting strategy side and newer perhaps to the specifics of the ISSB, which of course is what we're here to help you tackle today. Okay, fab. I'll leave that question available. So do let us know your thoughts in the background if you want to complete that. But in the meantime, we'll go back to the slide presentation and we'll get started in the content. Okay, so I'll kick us off with the first segment. So firstly, just a quick disclaimer to share with you all before we get started. And this is just to be clear about how we're going to be using company reporting examples in the session today. So these are really simply here to add some colour and inspiration. So we know sometimes seeing a real example can help you to put into practice what you're learning. However, of course, these examples are just one way to approach this, and they shouldn't necessarily be seen as the right or the best way to do this, but just some inspiration. Okay, with that established, we'll now kick off our first module, Prepare, which, as I've said, is all around building that solid foundation of knowledge and thinking about what you might already know about sustainability reporting. So to start this off, we'd like to cover three aspects. So firstly, we'll start with the purpose, so thinking about the case for sustainability reporting. We'll then move on to the landscape, so thinking about the evolution of different reporting frameworks and standards. And then we'll explain the global baseline. So that's the core concepts and the requirements in the IFRS S1 and S2 standards. So thinking firstly about purpose, we're thinking here about the market drivers for sustainability reporting and what it is that might be driving more organizations to pick up this topic. So to get us started with that, it would be great to hear from you all what your reasons are for joining us today and for focusing on the topic of sustainability reporting. So I've just launched the poll now, which should be visible for you. And you can let us know which of these, and you can select more than one, might be your reasons for starting to think or already having made some progress on sustainability reporting. So maybe it's the potential for regulation, maybe it's interest from your investors, maybe you want to share your own management's objectives and what you're trying to achieve in sustainability. Perhaps there's competitors or peer companies who are already reporting, or maybe you have other reasons as well. So feel free to put those into the chat if there's different reasons from those we mentioned already there that you might want to mention. Great, I see everyone starting to take place in the poll. We have lots of polls throughout the session, so I will move through them fairly quickly in the interests of time. But I'll just give everyone a few seconds more to have a think before we share the results. But if you miss taking part in this poll, we'll have a number of opportunities to do that throughout the session, so don't worry. Okay, let's close the poll there and we'll have a look at your answers. So I can see that potential regulation is coming out as the top driver for many of you, with investor interest and sharing your own management objectives coming in as some other reasons as well. So I think that's a very common picture that we see when we run these sessions in lots of different markets, as to why many organizations are thinking about this. So you're in good company globally there. Great, thanks for sharing that. So we'll now dive into a little bit about some of these drivers. So the first one I'd like to mention a bit more about is investors, which I know a number of you highlighted there was a reason that you're kind of starting to work on this topic. And so the data we're sharing here is showing that more than 5,000 investors are now signatories to the principles for responsible investment globally. And so what is it that's really driving this big increase in interest from the investor community in sustainability and sustainable finance? So what I want to highlight really about this interest from investors is that the key reason for it is actually the financial effects of these topics. So sustainability is not seen as a nice to have by investors anymore, but a fundamental factor that they need to understand in their decision making. And so the study we're looking at here comes from Morgan Stanley, and they found in the study of retail investors that their main reason for being interested in sustainable investing was the financial performance of sustainable investments. So let's take a little bit of a closer look at what we mean by financial performance. So it's important to remember today that we're going to be talking about disclosing financially material sustainability information. So we're going to talk a bit later in the workshop about what we mean by material, but we want to be clear from the start about the sorts of effects we're talking about here. So firstly, we're seeing effects on companies' financial performance, and this may often come through in the profit or loss statement. And so sustainability risks and opportunities may start to have financial effects, for example, by changing the revenue mix of an organization or its total revenue, if, for example, demand for its products and services change, or maybe if its production capacity was disrupted. And we can also see changes in expenditure as well. For example, if there are increased operating costs due to rising energy prices, or if there's a need to invest in research and development to capitalize on sustainability opportunities. Another thing we're going to talk about today is effects on a company's financial position. So a company's financial position is often shown in their balance sheet or their statement of financial position. So here again, we could see changes perhaps to assets or liabilities as a result of climate issues. We could see potential write-offs or changes in the value of assets. And another financial effect could also be changes to financing and the cost of capital. For example, potential changes in insurance premiums due to climate risks, or perhaps also opportunities to access new types of financing, such as green bonds. And then before we move into our next unit, I just wanted to highlight a couple of really important concepts relating to sustainability risks and opportunities. So as you can see here from this study, which is the World Economic Forum's annual Global Risk Survey, risks can evolve over time. So something that might pose a significant risk 10 years from now might not be the top risk that we're thinking about today. But what's important for sustainability disclosure is that we're starting to prepare for those risks that we could expect to arrive 5 or 10 years from now. And actually, to prepare for those risks, we might need to make changes already today that could start to mean there are financial effects in the near term as well. And so another important aspect of this is also the interconnectivity of different sustainability risks and opportunities. And this visual also comes from the World Economic Forum report, and it really shows how interconnected different types of sustainability risk are. So whilst when we're reporting about different sustainability topics under the IFRS standards, we might think of different topics as separate issues, of course, what we need to try and do in our reporting is think about how these issues are interconnected as well. Okay, so that's just an introduction to a few key concepts we'll come back to later in the day and really, the case for what we're doing here. So to talk us through the reporting landscape, I'll hand over to Lois now.
Thank you, Fiona, and hello, everybody. So Fiona's explained to us why sustainability-related disclosure is important because of the risks involved and investor interest, and we're now going to look at how the IFRS sustainability disclosures have developed within the landscape of existing reporting standards. But before we do that, we would like to ask you via a Zoom poll, what frameworks do you currently use for sustainability reporting? So you can choose as many of these as are applicable. Do you currently respond to CDP's questionnaire? Or do you use the Global Reporting Initiative standards? Use the Integrated Reporting Framework? The Sustainability Accounting Standards Board standards? Have you used the recommendations of the Task Force on Climate-Related Financial Disclosure, the UN Global Compact Principles, or something else? Now, if it is something else, please tell us what that is in the chat, and we'll keep an eye on the chat to see what you're using. Give you a moment to think about that. Somebody has said they're using the ESRS, the European standards. That's interesting. So in the interest of time, I'm going to end the poll here and share the results with you. And you can see that the majority are using the integrated reporting framework, which I know has been widely used in your jurisdiction, followed by organisations responding to the CDP questionnaire, some using SASB, but a variety of practice here, but mainly integrated reporting, which is good for reasons that we'll come on to discuss. So let's think about the IFRS Foundation and its structure. As you know, this is the organisation that has created the standards we're going to be talking about today. The foundation is a not-for-profit public interest organization that was established to develop high-quality, understandable, enforceable, and globally accepted accounting and sustainability disclosure standards. Now you see at the bottom there are two independent standard setting boards, the International Accounting Standards Board, or IASB, formed in 2001, and those financial reporting and accounting standards are in place in over 140 jurisdictions around the world. The International Sustainability Standards Board, the sister board, was formed in 2021, issued its first standards in 2023, following strong market demand for its establishment. Because these two bodies are within the same foundation, they work closely together to ensure that their standards complement each other. Their work is overseen by foundation trustees, and they are in turn accountable to a monitoring board of public authorities. So how did these standards come to be? Well, you'll probably recognize lots of the logos on this screen, and it looks a little bit confusing, but the main message from this slide is that there is a picture of increasing harmonization and standardization. So let's think about what this means. Well, all of the organizations whose logos you see on the screen today have contributed to the evolution of reporting standards. Many of them focus on the information needs of investors. Now, the arrows tell us that some of these organizations have been consolidated into or work with the IFRS Foundation. So look at the bottom, integrated reporting. The integrated reporting framework has been consolidated into the IFRS Foundation's work, along with the Climate Disclosure Standards Board work and the work of SASB. The TCFD, the Task Force on Climate-Related Financial Disclosures, has now ceased its work, but its work has been consolidated into the ISSB standards, and climate reporting is monitored by the IFRS Foundation. It's a similar picture with transition plan work. The transition plan task force work, to the extent it covers disclosure, is now within the IFRS Foundation. So to the left and at the bottom, these organizations effectively have been consolidated into the IFRS Foundation. Now, CDP has aligned its climate questionnaire with IFRS S2, which is on climate reporting, and the GRI is working very closely with IFRS Foundation to ensure that common disclosures and interoperability, as they call it, is secured. So much more harmonization and simplification here. Now, not many of you were using the TCFD recommendations, but we just heard that the TCFD's work has been consolidated into the ISSB standards. So what do you think is the answer to this question? Companies that disclose using the TCFD recommendations automatically comply with the ISSB standards. Is this true or false? Give you a minute to think about that. Let's share the results. So most of you said it was true, and I can understand why, because the ISSB standards have really been based in terms of architecture and some content on the TCFD recommendations, but actually the answer is false. So don't worry about this too much. The point we're trying to make is that whatever you've been using, whether it's CDP integrated reporting, you will be a long way towards conforming with the ISSB standards, but there are some differences, and that's what we're going to talk about now. So this little document on the left, if you're interested, will give you a thorough comparison between IFRS S2 on climate disclosure and the TCFD recommendations. But really, there are three types of differences. The first is just differences in wording, but to capture the same type of information. Secondly, S2 requires more detailed information in some cases. So this might be more information about how carbon credits are used to satisfy targets. And thirdly, S2 provides some additional requirements and guidance. And an example here would be sector-specific guidance we'll come on to look at briefly. But the point to take away from this is that whatever you've been using to date in terms of standards, that will be very, very helpful to you when you start using the ISSB standards. But just be careful because there are some differences. So the ISSB's main objective was to set a global baseline for sustainability disclosure, meaning a common language that gives comparable and consistent sustainability disclosure across capital markets. Now, the baseline can be added to with building blocks. What do we mean by that? Well, building blocks are tailored for specific multi-stakeholder needs beyond investor information needs that are catered for by the global baseline, and or requirements that fulfill jurisdiction-specific information needs. So we have the global baseline set by the ISSB standards, but in particular jurisdictions, governments, regulators, and others can add building blocks reflecting different and new requirements on top of the global baseline. And this just means that there's less duplication now that we have that consistent baseline for sustainability disclosure. The approach for the common baseline that's reflected in the ISSB standards has been endorsed by a number of organisations, including the International Organization of Securities Commissions. They announced their endorsement of the ISSB standards and have encouraged their members around the world to consider how they can incorporate ISSB standards into their regulatory frameworks. We have new audit standards to help auditors assure sustainability information issued by the International Auditing and Assurance Standards Board. As part of its jurisdictional and regulatory implementation program, the IFRS Foundation is supporting jurisdictions around the world that are planning and preparing for voluntary or mandatory adoption of the standards. And of course, there's work like our webinar today, which is designed to help stakeholders around the world who are thinking of voluntarily applying the standards. So I'm now going to hand over to our colleague Robert, who's going to start explaining the standards to us. Over to you, Robert.
Great, thank you, Lois, and hello, good morning to everyone. Indeed, we'll be now moving to the next section in this module, and I will give you a short overview of the IFRS S1 and S2. Yeah, when we talked about the business case and the market case for sustainability reporting, also the evolution of the landscape and how it's being simplified and rationalized. And now we will then talk about specifically about IFRS 1 and S2 standards. So as we start, it's important to know that there are some key terms that we should be understood. And you can find a definition in your handout, but I wanted to briefly mention them here. First of all, we'll be saying the phrase sustainability-related financial information quite a lot. This can refer to a broad set of issues, including climate, nature, or biodiversity, human and social, and other aspects. Sustainability-related information is information about companies' sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. And those sustainability-related risks and opportunities are those that could reasonably be expected to affect companies' cash flows, access to finance, or cost of capital. For example, it could affect the company's prospects. We will also often refer to general purpose financial reports, which includes a company's financial statements and management commentary. You might know this as a management report, management review, or strategic report. And it takes the different names, and some regulators require specific disclosure in certain parts of general purpose financial reports. So we will use then this generic phrase throughout. Right. Moving to the next section, and we were talking about TCFD and how the IFRS S1 and S2 were built on this architecture and the structure of TCFD. So also here you will recognize the same pillars, the same 4 core pillars or content areas coming from the TCFD, and now they are present in the ISB standards. So these are governance, strategy, risk management, and metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of those 4 content areas today in detail, and I encourage you to download the standards as part of your homework assignment to really familiarize with these requirements across these 4 content areas. Okay, so now we'll be then moving now to the standards itself, and first we'll look at IFRS S1. So to all preparers listening, let me start by saying don't be afraid. There's a lot to understand, but you might be surprised that the sum of the details you're already familiar with. And for all the accountants listening, you also should be relieved to see many of the conceptual foundations developed by the IASB in the ISSB standards. So there's overlap in terms of framing and vocabulary being used across these 2 standards. So let's start with the IFRS S1, or to give you the full title, General Requirements for Disclosure of Sustainability-Related Financial Informations. So S1 sets out general requirements for the content and presentation of sustainability-related risks and opportunities. Again, if you're familiar with TCFD, you will see the same architecture applied throughout the standards. S1 asks preparers to refer and consider to the applicability of the SASB standards and other sources of further guidance to identify sustainability-related risks and opportunities and identify material information. The SASB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. Finally, the standards can be used in conjunctions with any accounting requirements. Right, so that's about S1. Just a short introduction, just to give you this overview. And now moving to S2. So the scope of S1 is all sustainability topics except the climate, which is covered by S2. The second standards focus on climate disclosures building on the same foundations of S1. So again, S2 fully incorporates the recommendation of TCFD, sets all out requirements for a company to disclose material information about its climate-related risks and opportunities, and it requires disclosure of both cross-industry and industry-specific information. So in terms of climate risks, these include both physical and transition risk, which we will come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and greenhouse gas emissions, which we will discuss later as well. Preparers must also refer to consider the applicability of the industry-based guidance on implementing IFRS S2. As we already said, this is organized by industry, and that's to enable you to identify the metrics and disclosures applicable to your business model and operations. All right, and so how the 2 relate to each other? So it's important to know that S1 and S2 are not standalone standards. They are a package and must be applied together. Even when the company is reporting only on climate-related risks and opportunities, the company must still apply both IFRS 1 and S2. And this is because IFRS 1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. Also, as one explains the concept of materiality and how companies identify material sustainability related financial information. All right, so I'll give you like this general overview of the standards. Now let's consider some of the conceptual foundations that underpin standards, which might be new to anyone without accounting background. So these concepts helped us to understand how best to disclose information in order to meet the requirements of the ISV standards. So to start with, companies must fairly present a complete set of sustainability-related risks and opportunities. And the fair presentation also requires disclosures to be faithfully represented. To achieve this, the company shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. The reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The ISSB standards require companies to identify key connections, such as those between risks and opportunities, connections between the four content areas we mentioned before, and connection also between sustainability-related disclosures and main financial statements. How this can be achieved in the real world, in practice, we have a good example, and handing over to Lois to present it to you.
Thank you, Robert. Yes, and as this is our first example today, just want to remind people of the disclaimer that Fiona gave earlier, that the examples are really to inspire you and to illustrate certain points. They're not to be regarded as best or good practice, but this first example is to illustrate how a particular company shows disclosures about connected information. The example comes from the annual report of a company called BHP, which is a global mining company. And I'm going to just quickly summarize what they are connecting here. So in this extract disclosure about the impact on their business strategy and capital alignment and allocation, they're talking about the impact of climate risk. The first paragraph tells us that climate risk assessments and climate scenario analysis have been conducted, but rather than being regarded separately, they are integrated into and connected to the company's strategy and treated as a sensitivity in their capital allocation process. So here we see connections and alignment between the strategy, the company's capital allocation plans, and their decarbonisation goals. So three connections there. In the second paragraph, they tell us that they're undertaking studies to assess the effect of future physical climate risk on the company's operations, productivities and costs. So the connections there are from the present to the future, so that they know that when they get the results of that assessment, they're going to have to incorporate those results into their assessment of operations, productivities and costs. So they're going to connect them. Thirdly, in the light grey text at the bottom of the screen, you can see that there are connections to other pages in the report where we find information about the impacts of climate-related risks on operational activities, GHG emissions across the value chain, financial statements and production, revenue and expenditure. So a little example of how climate-related risks can be connected with strategic business and financial considerations. Back to you, Robert.
Yes, sorry. Yeah, thank you very much, Lois, for this example. Just to check your understanding on what we just discussed, we have another Zoom poll. So the question here is, what information should be considered for connected information? and we have three different categories. So whether there should be a connection between the four content areas: governance, strategy, risk management, and metrics and targets. Whether that's required connection between sustainability-related financial disclosure and financial statements, and C, sustainability-related risks and opportunities. So what is being meant by connected information as required in the ISSB standards? I'll give you a bit of a time to think about it. So please do select all the answers which apply here. And I will end the poll in a minute and show the results. Right, so if you were listening carefully, the connected information is they should be considered between all these categories. So A, B, and C are or the ones which should be selected to answer these questions correctly. So yes, you should endeavor to have connectivity between all of these in order to meet the requirements of the ISSB standards. Right. We'll be now moving to the next topic, important topic in terms of accounting, but also in terms of ISSB standards and materiality. So the standards are built on the concept of materiality as defined by the IFRS foundations. We're going to this into more detail later, but just to highlight that we will be referring today to material information, which is information that, if omitted, misstated, or obscured, could reasonably be expected to affect investor decision making. During the ISSB consultation on the exposure draft, one of the key feedback topics was that importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards, so the application guidance was published in 2023. A number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We're also in the process of gathering examples and case studies provided by our partners. The SASB standards were aligned with IFRS S2 to help preparers to seek industry-based guidance, and the FSA credential was also updated with more planned to come. I should also mention IFRS Foundation Capacity Building Program, which is a key part to support preparers, and the SSE training we're having today is one of our most important deliverables. All right, and we'll have another Zoom poll also to check your understanding, and his big question is a bit more specific, more practical. So let's say water is a vital input to your business, but the ISB standards do not currently have a specific standard on water. So what you should do in this situation? A, do not disclose anything about water. B, consult the sources of guidance listed by ISSB. Engage a consultancy to help copy your competitors' reporting. So yeah, there's certain topics which there's no developed standards yet, and water is one of these examples. And the question here is, what should be the right action in such situation? And I see a pattern in answers. Almost half of you already answered. We'll give you a moment. And I'll end poll just now. Right, so most of you answered correctly indeed. You should consult the sources of guidance listed by ISSB. So the answer B is the correct one here. Engaging with consultancies also might be a good idea, so that might be something you might want to consider as well. No, disclosing anything or copying your competitors' report are not the right options. So congratulations to everyone who answered correctly this question. All right, so now I'll be moving to the next section. Oh, there will be summary of the module 1, and Fiona will cover this for you. So over to you, Fiona.
Great, thanks so much, Robert. And as he says, that brings us to the wrap up on our first module. So we'll take a few moments now to recap on what we've covered and do a bit of an exercise as well to close off this module. So to start with, we reviewed the purpose of sustainability related disclosures. And a key takeaway we're going to hope that you'll leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability related information. So ultimately, if you're not aiming to make good use of the data that you're going to be collecting for your own strategic decision making, then you're missing an opportunity here and wasting some time. So, as well, if you also have operations in hard to abate or high impact sectors, it's likely that your competitors may also start to disclose these risks and identify the opportunities. And so that will start to leave your investors wondering why you're lagging behind and not managing those same issues that they are. And over time, that might start to affect your ability to raise funds. And then in our next segment, we looked at the evolution of the disclosure standards, and Lois took us through the formation of the ISSB and the aim to simplify the reporting landscape. And whether you're thinking about other voluntary disclosures or the ISSB standards, you shouldn't see these as competing with each other, but rather building on top with the ISSB standards, forming that baseline. And then finally, we introduced the standards themselves and covered off the important concepts that you're going to need to understand in order to use them correctly. And a key point I want to reiterate here is that these standards and the guidance alongside them are really designed to meet the needs of investors, and therefore they're heavily focused on those prospects that we discussed at the start of the unit relating to financial effects and performance. Okay, so that's a little bit of a summary, and we're now going to do a quick exercise together in Menti to get you to reflect a little bit on what we've covered so far, and also to start to think about some of the concept that could go into your organization's disclosure plan that you can build out through the homework exercise if you'd like to. So our first exercise is really getting you to reflect on how you're going to define your objectives for sustainability disclosures. So we think that setting clear goals for your reporting is really a useful exercise so that you're clear on what you're trying to achieve and you're clear with your stakeholders about how you're approaching this topic. So thinking in particular with these goals about what the reporting requirements are that you're trying to meet, what the stakeholder needs are that you're trying to serve, and maybe thinking about, what your starting point is now. How big of a difference will that look like in this new disclosure plan? Maybe you've got to completely start from the beginning, and so you've got to put in place quite a lot of things. Or maybe you actually have quite a lot of this already in place, and what you really need to do is just align it with these new requirements. So let's go into Menti now. I've reshared that link with you in the chat, and we will also share screens now so that you can see the other ways to join us. I can see lots of you have, but I also know that lots of people have so far not joined the Menti. So I would really encourage you to take part because it's a great way to really reflect and engage with the learning today. It's a long session to be sitting and listening. So I think, active learning through thinking this through can be really helpful. As I said, no wrong or right answers here, just really your thoughts. So as I said, the question here is, what are you trying to achieve with your sustainability disclosures? Do you already have a goal, or is there maybe a goal that's come to mind for you as we've been talking through these topics? And maybe some of those drivers that we discussed at the start of the session could be relevant here around your thoughts on regulatory compliance or investor interest, etc. Great. I think the first respondent we've had come through here has indeed mentioned investment. So using your sustainability disclosures perhaps to access new investment routes or maybe to communicate with your existing investors as well. We'll give it a few moments just for a few more of you to have a little think and let us know your thoughts. Yeah, again, so someone's mentioning attracting FDI, foreign direct investment. I think, as you've rightly identified, for many investors globally, we've already seen that these factors and sustainability information is increasingly important to how they're going to make their investment decisions. So absolutely, having a good sustainability disclosure approach will no doubt be a positive addition to your approach to attracting investors there. Okay. I'll give it a few more moments. It'd be great to have a couple more responses. So please do share your thoughts, even if they're just little thoughts. Being ethical is something that someone's mentioned here as well. That's fantastic that's a strategic aim of your organization to really have that ethical approach. Someone's mentioned climate readiness as well, indeed. So actually how you can manage and improve your organization's resilience, maybe to climate risks, and also to think about how to be ready for any opportunities as well is really key. And that's a good emphasis, I think, to place on your reporting. So someone's mentioned around transparency, which is very true, definitely. So enhancing transparency and building trust. Someone's put in several options here, which I think is quite a rounded approach. So thinking about how to meet regulatory requirements, identify risks for long-term value. Indeed, I think those are all relevant points to highlight here. Some people have said corporate social responsibility, maybe learning more about the topic. Indeed, I think reporting itself can be a learning journey for the organization. So it's only by starting to assess these issues and to put some information out there that often you start to uncover a little bit more about what the key issues are for your business and how you can tackle those. So treating disclosure as an opportunity to learn, I think, is a good way to highlight this. And then I'm seeing also identifying risks, investment readiness again, maybe thinking about the branding, or maybe you're thinking about the competitive position of your organization in the market. So being seen to be addressing sustainability risks, or actually managing your organization's impacts and capitalizing on opportunities can indeed be positive for your reputation and your competitive position. People have also mentioned complying or maybe contributing to international agreements as well, indeed, on climate change. So, as you say, all or many countries globally have signed up to the Paris Agreement. So, doing your part to demonstrate how your organization is aligning with those policy goals is not only a good thing to do, but is going to leave you ready for the future in terms of delivering against any regulatory requirements. Lovely. Thanks everyone for the thoughts. This is great to get your input here. Someone's mentioned for their specific company, Telesom, around sustainability for the environment, who are using ISO 14001, and also thinking about quality and customer satisfaction. So yes, also kind of balancing disclosure with some of these internal management standards that can help you to implement the right practices internally is a good approach. Reputation, transparency, lots of commonality, I guess, in some of the aims here. But yeah, hopefully that's a helpful exercise just to think through that objective. And as I think a number of you shown here, there doesn't have to be one objective, but I think trying to articulate for yourselves what that objective is from reporting is really helpful and something I'd encourage you to discuss and share with your colleagues. A few points we'd highlight here would be to think about any feedback that you might have had from your investors or other stakeholders already that can help to inform your approach. So maybe you're seeing a particular demand for investors for more progress on climate change, for example, and so that would be a particular area to focus on. And also thinking really about the future in these goals. So perhaps your organization isn't subject to any mandatory requirements now, but maybe that could change in the future. So thinking about how you're building readiness with this disclosure plan for any future requirements as well will be really key. Excellent. And I think as a number of you have highlighted, aiming to maximize at outset the internal benefit of collecting this information, as well as what you report, is really a good approach to take. Great, thanks everyone for sharing the thoughts. So that brings us, as I said, to the wrap up on this first module. I'll share my slide screen again, and then we'll hand over to Robert, who'll get us started with module 2.
Perfect. Thank you very much, Fiona. Yes, indeed, there will be no switching to module 2. And yeah, now we've introduced the initial concepts. Let's now dive into how to apply the ISB standards. So we're taking account additional disclosures, including any relevant geographical or sectoral requirements, as well as peer practices and your leadership objectives. So to break down the module 2, in order to understand how to ensure your disclosure meet global standards, we will look at 2 concepts in this unit. The first and the main focus of this unit will be how to apply the standards to achieve global baseline for disclosure. Once we cover that, we'll also discuss how additional disclosures fit. So to begin, let's focus on how to apply the ISSB standards as the global baseline. And we'll now switch to the first core content area, being governance. And this includes aspects that relate to the governance body in your company and how management is applied. So what is governance and what requirements are there in terms of governance in the ISSB standards? So for each of the core content areas, we'll discuss questions that you should ask in your companies to start identifying the information that will support some of the disclosures requirements, for example, as part of your gap analysis. So as we look at the governance and the management requirements, we can see that there are several that are fairly qualitative. So, for example, which bodies are responsible for the oversight and management of processes, controls, and procedures of sustainability-related risks and opportunities? For example, is management responsibility delegated to a specific role or committee? So another question worth to ask will be how and when do they get informed about sustainability-related risks and opportunities? Further, how these issues inform strategy, decision-making, risk management. This could include setting targets to manage sustainability-related risks and opportunities. And then whether progress against these targets links to executive remuneration. So for more information, you can make use of the SSE checklist tool, but please remember it's not a replacement for reading and using the full ISSB standards. So we'll now look at a couple of examples of these, what we mean in practice. And again, Lois will present these to you. Over to you, Lois.
Thank you, Robert. And of course, when we look at these examples, it's important to remember that there's no specific or required way of setting up a governance model globally. I mean, there might be requirements that apply specifically in your jurisdiction, but you'll see from these 2 examples 2 different approaches. So this first example is from a company called Yara. It's a huge global crop nutrition company that operates in 60 countries. And in this governance model, you can see how highly integrated the governance model is. The sustainability governance, if you look in the pale green boxes right in the middle of the slide there, is actually it's linked to human resources and ethics and compliance, global climate and energy, corporate affairs, and so on. So the sustainability governance team itself, they report to the chief financial officer, who in turn reports right up to the board, audit and sustainability committee and beyond to the board itself. We also see from the arrows, the way in which oversight works. That's indicated by green arrows, how reporting lines are managed, and also where there are competencies within the organisation on sustainability. So there's cross-cutting input to activities on sustainability, and that also comes from the sustainability network, which you see right at the bottom there in the pale beige box. So a lot of cross-cutting activity in this particular example. The next example we have is from Toyota, which is a car manufacturer. They also manufacture hybrid electric vehicles. And this extract from their annual report explains the role of the Sustainability Committee within the company's wider governance structure. So the Sustainability Committee is one of the business execution committees that reports direct to the President and Board of Directors. The extract shows various things: how frequently the committee meets, which is generally once a year or as necessary. It shows who chairs the committee, which is the executive in charge of enterprise risk and compliance management, which is also the location within the organization of how this particular committee is managed. So contrast that with Yara, the example we just looked at, where responsibility was with the chief financial officer. But where we do see similarity here is that the members of the Sustainability Committee come from lots of different parts of the organization, including HR, technical executives, audit and supervisory board members, and external experts. Finally, in this example, we see the actions that the sustainability has taken in the reporting year. They approve action plans on sustainability and targets, they evaluate activity results, they determine the direction of the approach to sustainability, including through capturing the opinions of stakeholders and looking at social trends. And they also revise the sustainability policy. If you go to their actual report, you'll find that they link you to the sustainability policy using a QR code. So quite a comprehensive analysis of their governance. So it's over to Fiona now to take us through the next core content area.
Great. Thanks, Lois. So hopefully those governance examples have helped make that aspect reasonably clear. And that brings us on now to our next core content area, which is strategy. So there are more disclosure requirements in strategy than for governance, but it is also where companies can really start to see the benefits from sustainability related opportunities and being prepared for those risks as well. So as you can see, there are three high-level aspects that we focus on in this area. So firstly, defining the risks and opportunities. Secondly, thinking about their effects across the business. And then finally, coming on to resilience. So we'll take some time to go through each of those now. But to get us started, so the IFRS S1 and S2 disclosure requirements on strategy are really around helping the users of the report to understand how the company is managing sustainability risks and opportunities. So if we first look at the requirements on the risks and opportunities side, here are some of the questions that you'll want to start asking yourselves internally. So when we're disclosing information about the risks, content that's required will include describing the effects of the risks, the time horizons under which those effects are expected to occur, and that's where we also need to keep in mind that financial effects could occur before the risk or opportunity materializes, or later, or maybe they could change over time as well. If you remember back to that concept we introduced about time and sustainability at the start of the session. And so the last two questions here in particular are focused on the climate requirements of S2. So for example, investors will also want to understand the different types of risks and opportunities. And this is where we see many companies drawing from the categories used in the TCFD, which talked about both physical and transition climate risks. And we'll come on to explain a little bit more about both of those later on in the session as well. But overall, both of the standards here provide guidance to help companies to identify and disclose these risks and opportunities. So again, let's have a look at an example to help us start to understand this a bit better. So our first example comes from Mondi Group's 2024 integrated report. And Mondi is a multinational packaging, paper products company with operations across Europe, North America, and Africa. In the left-hand extract here, we're seeing an example of the risks that the company has identified and a summary of how these risks align with four different strategic categories for their business, and also the delegated risk owners for these particular risks and opportunities. And then within the report itself, you can find more information explaining each of these different risks they've identified. And then on the right-hand side, because they've identified climate change as one of their strategic risks in the first list, they go on to explain and break down the climate risk types using that physical and transition risk framing that I talked about, and break out the different types of risk they expect to face here. And they also disclose information here on the time horizons for these risks, the estimated financial impacts, and the different climate scenarios, which we'll go on to explain now and cover some more examples for as well. I should say with all of our examples, we know they can be a little small, and what we see on the screen is really just a short summary of what the actual disclosure is. So I'd encourage you to use the links that we've provided in the presentation handout to take a look at each report and the pages we've highlighted to read some more detail. So as I've mentioned, another important aspect here is to think about what we discussed at the beginning relating to time. So you might remember we were talking about time earlier, and we said that it can be quite a different factor when we're thinking about sustainability disclosures. So we'll try to be a bit clearer here on what we mean by that. So in the standards, you're asked to identify the time horizons over which any material effects are expected to occur. And how you define short, medium, and long-term horizons is going to vary between companies, and it will depend on a number of different factors as well. So for example, the right time horizons to use for you could depend on your investment and business planning cycles, on the strategic planning horizons of your organization, or indeed the life of the assets, as well as other factors that might be relevant for you. So what's important to keep in mind here is that you do need to define those time horizons. So don't expect that your investors will necessarily know what you mean by short or medium term unless you provide them with that quantitative definition of how you're using that. Okay, so moving on now to the second group of disclosures in the strategy category. The first section there was all around identifying the risks and opportunities, and this next section is to think about what the effects of those risks and opportunities are, and where those occur within the business as well. So to start tackling these disclosure requirements, companies are going to want to think about what the effects are, how they describe them, and maybe what their responses are that they have planned to mitigate those different effects. And so again, let's have another look at an example here. So this example comes from, BASF, who are a global chemical producer. And this example we're really using to show how they've explained the effects of sustainability issues across different aspects of their business model and value chain. So just a short summary here. I'd encourage you to read the detail on this one to understand it a little better. But this diagram I think is helpful because it visualizes how they've really considered the different aspects of their operations and value chain in their sustainability strategy. So you'll see they talk about upstream of their business and that actually renewable energy and the procurement of materials is a really important aspect for how they're thinking about sustainability and how they work with their suppliers on that. And then within their own operations, they're prioritizing projects that can help them to improve their efficiency in their processes, using smart technology and other tools to save money on energy costs and also reduce their carbon emissions. And they also go on to talk about their downstream. So thinking about how they're kind of prioritizing the development of products where there's a demand for more sustainable solutions and thinking about how they can work with their customers on that aspect. And in the commentary that we have alongside this diagram, we also see that they target achieving 10 billion euros in sales revenue by 2030 from products that contribute to the transition to a circular economy and a more sustainable business model. So it's interesting to see, how they're really thinking holistically about how they can embed these different effects of risk and opportunity across their business. So sometimes one of the obstacles we know that companies can face when they're reporting on the effects of these risks and opportunities is what level of detail needs to be disclosed. And so in that example we just looked at there, we were mostly showing you qualitative information and descriptions. But what about quantitative disclosures as well? So a company is required to disclose both quantitative and qualitative information about the financial effects of sustainability risks and opportunities. However, there are also criteria within the standards which set out when only qualitative information is required. So using qualitative information is allowed when a company cannot separate the effects of a climate risk from other types of effect, if there's a high level of measurement uncertainty, and also if the company itself doesn't currently have the skills, capabilities, or resources to provide that quantitative information. So that brings us on now to the last part of the strategy component. The first part there was what were the risks and opportunities. The second part was thinking about the effects. And now we're going to go into looking at how the company is preparing for uncertainties and ensuring its resilience to the future. And so this really gets into the practices and processes that a company will have in place to assess its resilience and think about any strategic adjustments that it needs to make. And here disclosures are required on any types of assessment that have been used, and for example, how climate scenario analysis may have been considered. So overall, companies are asked to do climate scenario analysis and to try and disclose the inputs and assumptions that they're using for that. So again, a couple of examples to show how some companies are approaching this. So firstly, we have Stora Enso, which is a Finnish and Swedish forest products company. And they show us in these diagrams here really how they're kind of transitioning their business to capitalize on the growth opportunities they're seeing for sustainable products and also offset some of the risks that they're seeing regarding the decline in the sales of perhaps their less sustainable business areas. So their current sort of business as usual activities are relating to forest, pulp, and traditional wood products, where they expect that there might be a decline in sales. So instead, they're starting to prioritize investment in sustainable building solutions, renewable packaging, and biomaterials. So they show here a projection of how they expect the makeup of their sales to change from their sort of 2006 baseline to how it's shifted already today, and then in the future, how it's going to continue further with those strategic growth areas starting to make up a much larger share of their business sales. So we're really getting a picture here of how they've sort of analysed, the future changes in their business that might happen and the steps that they're then taking to position their business differently and transition from being a traditional paper company to being a more resilient renewable materials company in the future. And then our second example we have is Solvay, which is a Belgian multinational chemicals company. And then in this example, we want to highlight in particular how they are disclosing the information on the financial effects and how they've conducted their scenario analysis. So they're transparent in their reporting about the estimates that they've used in the scenario analysis. So probably the detail here might be a bit small to read on the screen, and again, recommend looking at that in the slides. But to summarize, they've provided transparency over which scenarios they've used, the different sources that they've drawn those scenarios from, and how they've worked with both internal experts and consultants to conduct that assessment. And then in the second excerpt of the disclosure, at the bottom of the screen in that table, here we see how they've disclosed their expected financial effects. So they've broken out the different financial impact areas that they expect to see. And they've used a qualitative scale from a -3 to a +3 score to indicate the potential direction and magnitude of financial effect from these different risks and opportunities. And they've broken that out under two different climate scenarios there, a 1.5 and a 3-degree scenario. So an interesting example to show how people are starting to try and quantify some of this information. Okay, so just to wrap us up on this section, a quick poll question, just to test whether you heard the point we mentioned about this qualitative and quantitative information mix. So the question to test your thinking is to let us know when you think it is allowed for a company to disclose only qualitative information, or maybe a mix of qualitative and quantitative information about current and anticipated financial effects. So you can select more than one option here, but let us know which of these options you think is a valid criteria under the standards for disclosing qualitative information. Give you just another 30 seconds maybe to have a little think about that. I know some of these questions require a little bit of reading and thinking back to what we've already covered, so I'll try not to rush that too much for you. Okay, I'll just give it maybe another 5 seconds to have a little think, and then we'll talk about the right answer. All right, let's close the poll there and I'll show you the results. So indeed, as most of you who took part correctly guessed, A and B are the correct options. So indeed, if you can't separate out the effects from other types of risk or opportunity, or if there's too much management uncertainty to be able to quantify, those are both valid reasons. However, as most of you correctly guessed, indeed, it's not a valid reason to avoid disclosing information if it sheds a negative light on the company. Indeed, of course, it's important to be transparent and balanced with your investors. So if you do have information that suggests there could be material potential effects and you can quantify it, you should aim to do so. And if you take a look at some of those disclosure examples that we've shared with you, you will see those companies are providing information about both negative and positive financial impacts there. Okay, brilliant. Well, that moves us on from the overview of strategy there to talk a bit more about some of the climate specifics. So over to you for that, Lois.
Thank you, Fiona. Yes, the governance requirements we looked at earlier in S1 and S2 are very similar. So there are no specific additional requirements for climate. But when you're disclosing information related to strategy, there are specific and additional requirements in S2 regarding climate, although the structure is broadly the same. You just need to realise that there are some specific requirements for climate under strategy. Now, this slide is entitled From TCFD to ISSB, but don't worry if you're not familiar with TCFD, it doesn't matter, because the list that we're going to go through is a list of things you need to be aware of when you're making disclosures under the strategy pillar in the climate standard. So, first of all, S2 requires a company to refer to and consider the applicability of industry-based topics. Now, there's a separate piece of guidance from S2, which is the industry-based guidance you can refer to, and that will give you all the guidance you need to respond to that. But to give you an example, the industry-based disclosure topics help different sectors understand what might be most relevant and material for them to report. If you are in the personal products industry, for example, and manufacturing detergents or soaps, etc., the industry-based stand guidance will suggest that you look at where you get your palm oil from and whether it comes from an accredited and sustainable source. Secondly, S2 requires information on where in the business model and value chain risks and opportunities are concentrated. So in the case of climate change, this might be involve you looking at physical climate risks and considering whether you have any assets in areas that are particularly vulnerable to things like flood risk. Thirdly, in describing the effects of climate-related risks and opportunities, S2 requires disclosure about how a company has responded to and plans to respond to the risks and opportunities that it's identified. And this might include a response in the form of developing a climate transition plan. We're going to talk about that in a minute, or setting targets to achieve climate-related goals. As we've heard from Fiona, companies are required to disclose information about the current and anticipated effects of risks, including climate-related risks and opportunities, on their financial position, performance, and cash flows. And S2 sets out criteria for when quantitative and qualitative information is required. So in some cases, you can just supply qualitative information. Fiona just talked about this, for example, where a company cannot separately identify the effects of a risk or opportunity, a climate risk or opportunity from other risks. Or they can't identify the extent to which it affects the financial statements. When preparing this type of information on anticipated financial effects, the company is only required to use all reasonable and supportable information available to it at the reporting date without undue cost and effort, and an approach that's commensurate with their own circumstances. I provided you with a link earlier to new educational material that really explains this in much more detail and very, very simply. So do have a look at that, because there's some great examples in that educational material as well. Fiona told us that for the strategy disclosures, a company is required to use scenario analysis in the case of climate change, climate-related scenario analysis. But bear in mind that the standard doesn't specify which scenario or scenarios are to be used for assessing climate resilience. That is for the company to decide using its judgment. And finally, S2 requires information about the company's resilience, how resilient its business model and strategy is to climate-related risk, and additional information might be needed on any areas of uncertainty the company's encountered in assessing its resilience, whether and to what extent it has the capacity to adjust and adapt its strategy and business model. So I just mentioned that one of the responses a company might have to the effect of climate risk is to set a transition plan. And S2 defines a transition plan as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition to a lower carbon economy, including, for example, greenhouse gas emissions reductions plans. If a company has a transition plan, it is required under S2 to disclose details of it, but there's no requirement to have a transition plan. It's just one of the possible responses to the effect of climate risk. So if you do have a transition plan, here are some points to note about it. Because it is part of an aspect of the company's overall strategy, it should align with that strategy, as well as the business case and business motivation for the transition plan. It should align as far as possible with the goals of science, including what science says about the requirements for net zero to be achieved, or alignment with Paris Agreement goals. The transition plan must set long-term transition plans, transition goals, and these should be supported with clear mitigation and adaptation activity plans and interim milestones to monitor progress towards the long-term goals. The plan should be transparent about any uncertainties that may be associated with its success, such as what is it dependent upon for success, what are the risks and challenges of executing the plan, and how will residual and unabated greenhouse gas emissions be treated. The transition is going to proceed in different ways for different sectors, and therefore you could look at sector-specific pathways that have been explored by different organisations to consider how your company's transition plan might unfold. And finally, the transition plan will be evaluated by investors and others, and it should have the hallmarks of credibility that organisations like those have set, and we're just going to tell you about some resources to help with that. So there are lots of organisations that develop transition plan resources, and we just mentioned very few of them here. The triangle on the left is just designed to show you that some of the organisations that have developed transition plan resources, such as the Glasgow Financial Alliance for Net Zero and the Transition Plan Task Force, they've developed their work to build on and support S2 and the ISSB standards. But most importantly, in this list, in this little row of resources we show you, is that the IFRS Foundation itself has recently issued educational material on transition plans. So please do have a look at that ISSB guidance, which also has some useful examples in it. The Sustainable Stock Exchange, one of your hosts today, has also recently issued model guidance on climate transition plans. And at the back of that document, you can see in an appendix the hallmarks of credibility for a transition plan, amongst other useful information. The sector pathways we described earlier, they've been set up by various organisations, including the Glasgow Financial Alliance for Net Zero, that set out sector pathways for financial institutions and real economy companies. And as I mentioned at the beginning, the Transition Plan Task Force work on disclosure has been incorporated into the ISSB's work, but their disclosure framework and other guidance, including sector guidance, is still available to look at and is a very helpful transition plan resource. So you'll be pleased to know, everyone, that we are going to take a break now. So please take this opportunity to have a drink, have a stretch, think of any questions you'd like to ask us, pop them in the Q&A box. We'll play you some relaxing music and see you back here in 5 minutes. Hello, everybody, and welcome back. Hope you had a chance to have a bit of a stretch and a drink and that you're ready to go on to the next core content area of the ISSB standards. And this one is about risk management. And the risk management requirements ask companies to describe the processes that they use for managing sustainability-related opportunities, as well as how those processes fit into their overall risk profile. So what the standard is asking for is what processes and policies are used to identify, assess, prioritize and monitor sustainability related risks and opportunities, and are those processes integrated into the company's overall risk management processes. So there's no set risk management process, of course, but you might want to think about internally in your company, what sort of inputs and parameters do you use for risk management, whether and how sustainability related risks and opportunities are prioritized, how the nature, likelihood and magnitude of those risks and opportunities is assessed, so what criteria you use, what the monitoring process is, and whether and how processes have changed since the last reporting period. So just note that the two content areas we've already covered on governance and strategy are really asking for information about your governance and strategy. But in this case, the information you're being asked about is about the processes that you use. Now, again, the risk management requirements across S1 and S2 are similar, but there are some additional considerations for climate. Again, the ISSB standards really are consistent with those of the TCFD, but don't worry if you're not familiar with them. The point to note is that S2 asks for details about the input parameters you use to identify risks, whether and how climate-related scenario analysis is used as part of your process to inform risk identification, what changes have been made in your risk management process, and similar considerations for opportunities. Now, in the case of climate-related risks, the IFRS S2 does give us a definition of climate-related risk. That's in the appendix to the standard. And the risks come in two types, transition risks and physical risks. So transition risks arise from efforts to transition to a lower carbon economy, and they're often categorized as being policy and legal, technological, market and reputational risks. And you see some examples of these in the middle of the screen. Transition risks could manifest in increased pricing of greenhouse gas emissions, more reporting obligations, exposure to litigation, costs associated with lower emission technologies, changing customer behavior, perhaps giving the meaning that customers don't want to buy certain products anymore, and uncertainty in market signals. And the definition of physical risks, physical climate risks, is also given, and these can be acute risks, which are event-driven, such as weather-related events such as storms, floods, droughts, or heat waves, and they are increasing in severity and frequency, or chronic physical risks that arise from longer-term shifts in climatic patterns, so changes in rainfall and temperature leading to sea level rise, reduced water availability and quality, biodiversity loss, and changes in soil productivity. And again, you can see some examples in the middle at the bottom of the screen. But in both cases, the transition and physical risks carry financial implications for a company, such as costs resulting from direct damage to assets from physical risks, or changes in resource availability and extreme temperature, meaning that perhaps employees can't work outside in construction industries, but those financial effects can manifest in changes to cash flows, access to finance, and cost of capital over different time horizons. Similarly, in S2, we have a definition of climate-related opportunities, and these refer, of course, to the potential positive effects arising from climate change for a company. So types of opportunities might be from resource efficiency. Improving resource efficiency right across the value chain, or being able to be more efficient through lower emission sources of energy. Opportunities can come from supportive policy incentives being put in place to encourage climate-friendly behavior, from the use of new technologies, access to new markets from developing products and services in response to changing consumer behavior, and being able to increase your company's resilience by differentiating yourself against competitors and developing more climate-aware products and services. So they're just a few examples, but again, these opportunities can manifest in financial effects, mainly positive effects perhaps on revenue from this access to new markets and development of new products, it can manifest in perhaps better access and cheaper access to finance, it can affect your cost of capital, and these financial effects can manifest over different time horizons. Let's have a look at an example here. Now, this example is from a company called the RS Group. It's a UK-based distributor of electrical and industrial equipment, and it's got global operations. Now, the RS Group have been analysing their climate-related risks and opportunities for quite a number of years and disclosing them as part of their annual report disclosures. In another part of the report, not the one you see in the extract here, they've identified 10 principal risks, one of which is climate-related transition and physical risks. And this extract describes some of the physical risks. Their most significant physical risks relate to the impact of extreme heat on their distribution centres. You can see that on the first row there. And also the potential for extreme weather events to cause physical damage and disruption to their customers' supply operations. You can see a little red wheel on each row, and that shows how the risks affect operational and strategic parts of the business. You can also see how the risks are connected to the wider business strategy and to the particular stakeholders that are affected. In this extract, the company describes the nature of the physical risk in detail. They tell us who is the business owner of the risk, what metrics they're using to monitor the emergence or management of the risk. So the metrics are set out there. Sorry, I think we're losing the slides a bit here. Thank you to whoever's managing that. But at the end of the slide, I can tell you that the company also explains what they're actually doing. So their actions to upgrade their buildings, for example, to make capital investments and business continuity planning, and also what they plan to do by looking at their projections for the future and examining the risks under different climate scenarios and what that might mean in terms of the impact on future annual operating costs. So we're going to hand over to Robert now for the next core content area.
Perfect. Thank you very much, Lois. Indeed, we'll be now moving to the next core content area, which is metrics and targets. Sorry, I have a... Right. Sorry. Yes, we'll now spend some time reviewing the disclosure requirements on metric and targets, and we'll then look at it more in detail. let's now start with metrics. So requirements on metrics are designed to enable investors to understand a company's performance in relation to its sustainability-related risks and opportunities. So preparers should disclose information explaining how the metrics are defined. Further, if they are absolute or relative, if they have been validated by a third party, as well as the methodology based on which the metrics has been developed. So, for example, what is the method of calculations, what are the inputs, and what are the limitations, and what assumptions are involved. So that's about the metrics and the considerations here needs to be taken when thinking about them. And let's now move to the targets and the questions needs to be asked regarding targets. So requirements on targets are designed to enable investors to understand the targets a company has set to monitor the progress towards achieving its strategic goals. So in accordance with the standards, the disclosures should include whether the targets are qualitative or quantitative and whether they are set voluntarily or required by law or regulation. Of course, the targets needs to include the metric used for that target and then to monitor the progress towards its achievement. And another element important when setting a target is the baseline period from which progress is measured and the period to which the target applies. There also should mention whether there are any milestones and interim targets. And finally, whether there has been any revision to the targets together with the explanation about revisions and to how to achieve that and how it can be done. Again, we have another example, and Lois, over to you.
Thank you, Robert. And this example is from a company called CLP. And CLP is one of the largest investor-owned power businesses in Asia Pacific and aims to be a leading responsible power provider. Now, you've probably noticed that most of the examples that we've shared with you in this presentation so far have been about climate-related risk and opportunities. But here we have an example of targets set in relation to waste management and metrics used to measure pollution and waste. So these CLP explains in the top right-hand panel there that they have a group-wide medium and long-term target for waste for the years 2025 and 2030. So they know what their targets are. And then the bottom panel, what they're doing is they're telling us the 2024 results, their target by the end of 25 and the target by the end of 2030. And you can see that really, apart from the top line, they have met their targets already. Now, the other thing to notice about this is that these targets are set within the context of a wider strategy. And this goes back to the point that Robert was explaining earlier about connectivity. So the targets are set within that strategy and connected with it. The other thing to note is that in the top left-hand panel there, you'll see that there's a little grey text saying SASB reference and GRI reference. And that's because the metrics for waste management and material use have been calculated in line with the SASB and GRI standards, because at the moment the IFRS Foundation doesn't have a waste management standard or educational material. So yes, I think that's all we have to say about the CLP example. So I'll hand back to you, Robert.
Yes. Great, perfect. Thank you, Lois. Yeah, we'll be moving then to some climate-specific considerations when talking about the metrics and targets. So to do that, we'll then look at the TCFD framework again. So TCFD framework included recommended disclosures, which IFRS S2 builds on and adds to as a part of required disclosures. So for example, IFRS S2 requires disclosure of industry-based metrics relevant to company's business model and activities. Additional disclosures are required on greenhouse gas emissions, including separate disclosures on for the consolidated accounting group and associated joint ventures, and information about the company's financed emissions. Further, in addition, IFRS S2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 greenhouse gas emissions disclosures. So it's important also to note that while IFRS S2 does not explicitly require a company to disaggregate its greenhouse gas emissions disclosures by the constituent gases, IFRS S1 includes requirements on disaggregation that would result in the disclosure of those gases being required if such disaggregations provides material information. So it's a bit technical here, but I'd like to remind everyone you can access more information on climate metrics in the SSC training tool on this topic. We'll share the link in the chat, and you can also find it on the SSC's website. All right. Likewise, there are some additional disclosures compared to TCFD for targets as well. So, for example, IFRS S2 requires disclosures about how the latest international agreement on climate change has informed the target, whether the target has been validated by a third party. Further, IFRS S2 also requires disclosures of more detailed information on greenhouse gas emissions targets, including the use of planned use of carbon credits to achieve the net greenhouse gas emissions targets. So, additionally, IFRS S2 also includes requirements to disclose information about approach to setting and reviewing each target and how it monitors the progress, including whether the target was derived using the sectoral decarbonization approach. All right, so this was about the differences and the requirements TCFD versus ISSB, and we'll be now moving to more detailed, more specific metrics on greenhouse gas emissions. So questions on greenhouse gas emissions often come up when talking about metrics and target disclosures, so we wanted to address some of them here briefly. For those who might not be familiar with three different scopes, we have scope 1, 2, and 3. Scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as the company's facilities and vehicles. Scope 2 includes emissions from generation or acquired and consumed electricity, steam, heat, and cooling, such as the electricity their company is purchasing. Scope 3 is then all other indirect emissions that occur in the company's value chain. So IFRS S2 requires a company to disclose its absolute gross scope 1, 2, and 3 greenhouse gas emissions in accordance with the Greenhouse Gas Protocol standard, unless a jurisdiction requires a company to use a different approach of measurement. If the company is using a different measurement method, there is a transition relief to use the method in the first year of applying the standard. Additionally, S2 requires whether and how the company is using to disclose whether and how the company is using an internal price on carbon for decision making, and finally, whether and how executive remuneration is linked to climate change. On May 29th this year, the IFRS Foundation has published new educational material presented in a Q&A format detailing the greenhouse gas emissions disclosure requirements under IFRS 2, including a measurement, use of the Greenhouse Gas Protocol, and how to report Scope 1, 2, and 3 emissions in line with the standard. Please do review this material, which is very helpful in this rather complex and new area of accounting. And how this, again, can be done in the real world. And we have another example, and we'll have Lois presenting it to you.
Thank you. Thanks, Robert. And I just provided the link to the new educational material in the chat, so do have a look at that. It's really useful. So this example is from a company called Enel, which is an Italian producer and distributor of electricity and gas. And it's from Enel's 2024 GHG inventory. So they produce a separate publication that really sets out their GHG emissions in a lot of detail. And it starts with a description of the company's ambition to achieve net zero emissions by 2040 and promote energy generation from renewable sources. So again, we see a link between strategy and the metrics that are set out here. At the top of the slide, you can see the company's carbon footprint broken down by scope 1, 2, and 3 emissions. In the shaded bars, we see the 2022 results in the shaded graph bars, and that shows the base year when the company started, well, one of the base years in which they were measuring their greenhouse gas emissions, and the dark blue graph bars show the greenhouse gas emissions for 2024. So what you can see is a comparison of scope 1 and 2 and 3 emissions over the years from 2022 to 2024, but you can also see what the overall trend is, and you can see that there's a fall in GHG emissions over these years. But the other thing to notice is you can see the greatest source of greenhouse gas emissions, which is from scope 3. So quite a lot of detail in a small extract at the top of that screen. At the bottom of the screen, we can see an extract from the company's breakdown of scope 2 emissions. So Robert just told us that the requirements encourage companies to disaggregate or break down details of their greenhouse gas emissions. In this case, the scope 2 emissions are broken down by business activity, which is power generation and others, by source. So the sources are from electricity consumption from the grid in power plants and from electricity consumption from the grid in terminal ports in particular locations. We also see the breakdown in years again, so comparing 2022 and 2024. And finally, there's a breakdown or disaggregation by calculation method. So there's the location-based method for scope 2, which reflects average emissions intensity of the local electricity grid the company is connected to, and the market-based method that reflects emissions from electricity based on the contractual terms the company has entered into with the provider. Now, that sort of the calculation method only applies to scope 2, but you can see from this extract some of the ways in which the company breaks down or disaggregates their greenhouse gas emissions. So let's have another Zoom poll. And the question here is, what is the objective of metrics? That is, what is the objective of the metrics requirements in S1 and S2? And you can select all that apply. I'll give you a minute to think about that. I can see a clear pattern emerging here, so in the interests of time, I'm going to share the results with you. Yes, most of you are correct. The objective of metrics is mainly A and B, the first two. Of course, metrics can help users of information understand the company's assumptions for the future, but the reason we've asked you this question this way is to encourage you to read the standards, because at the start of each one of the main core content requirements, the standards set out the objective. So in the case of metrics in S1, this is set out in paragraph 45 of S1, which tells us that the objective of metrics is to enable report users to understand the company's performance in relation to its sustainability-related risks and opportunities, and to understand progress towards any targets. So if you are in doubt about exactly what to report, always look at the objectives of the requirements, and that will help you craft your disclosures. Of course, C isn't wrong, it's just not what it says in the standard. We just want to encourage you to read them. So let's go on to the second part of the Align module, and this is about how you integrate disclosures you make in response to S1 and S2 with any other disclosure requirements that you want to or might have to respond to. So we talked earlier, didn't we, about the baseline. So I won't go into this in detail, but the point is you might want to make disclosures in addition to those that are reflected in S1 and S2 requirements, because there are local listing requirements that apply to you and companies in your supply chain, and they may be jurisdiction specific. There may be policy objectives that encourage or require you to make disclosures, perhaps to show that you qualify for incentives like tax cuts or subsidies for sustainable practices. You might want to make additional disclosures to align with emerging industry practices or to follow sector peers, or to provide information to a wider stakeholder group than simply your investors. So, as we talked about at the beginning, the IFRS Foundation is working with regulators and bodies around the world to progress the adoption of the ISSB standards. As at June, the IFRS Foundation published an update on the global uptake of the standards, and I think 36 jurisdictions had adopted use or were finalising adoption of the ISSB standards. If you're interested in this, there's a number of other resources you can look at, including some profile reviews issued about jurisdictions adopting the standards or in consultation to do so. There's a regulatory implementation program and a roadmap development tool. So some of you have already asked about interoperability. How do you work both with the standards that you're already using or guidances and the ISSB standards? We've already talked about this a bit, so I won't go into it in detail. We know that CDP has aligned its climate framework, its climate questionnaire with the ISSB's climate standard. The GHG protocol is the protocol that must be used for the calculation of greenhouse gas emissions under the ISSB standards. And just to say that the IFRS Foundation is actively involved in updates to the GHG protocol standard and is involved in the GHG protocol team's governance arrangements. We'll talk about GRI in a moment. We've talked about the transition plan task force disclosure related work having been adopted by the IFRS Foundation, and that's now reflected in the Great Transition Plan guidance that they've just put out, we mentioned earlier. But also ISSB is working with the task force on nature-related financial disclosures to consider how they can build upon the TNFD's recommendations to meet investors' information needs, and that's part of their work on biodiversity. So I said we'd come back to ISSB and GRI. They have issued in the past some interoperability findings showing that their climate requirements are very well aligned between GRI and ISSB. They have a memorandum of understanding where they jointly commit to identify and align common disclosures. But the most important thing to take from this slide is that in June 2025, the GRI's standard setting board granted equivalence to IFRS S2 climate-related disclosures for scopes 1, 2, and 3 under GRI's standard 102. Now, what this means in simple terms is that it's only necessary to provide details of your or prepare details of your greenhouse gas emissions once, because the GRI and ISSB requirements on GHG emissions are regarded now as equivalent. So that's good news on simplification. On biodiversity and nature, we heard just now that ISSB will consider how to incorporate the recommendations of the Task Force on Nature-related financial disclosures, but is also working with GRI to deliver full-on interoperability with the GRI's Biodiversity Standard 101, and that will feed into the ISSB's project on biodiversity ecosystems and ecosystem services. So I think a while ago, we heard that there's certainly somebody in the audience who had been using European sustainability reporting standards that have been developed to help companies that are required to make sustainability disclosures under the European Corporate Sustainability Reporting Directive. Now, some of you might know that that directive is under review at the moment with a view to simplifying it. But the important point to note here is that, again, the IFRS Foundation works closely with the European standard setters to ensure as much interoperability between the European standards and the ISSB standards as possible. They've already found a high degree of alignment in climate-related disclosures, and the differences between them are really to do with the fact that the ISSB seeks information for investor group, and the European standards seek information not only on risks and opportunities, but also on impacts for a wider stakeholder group. When we asked you at the beginning what type of standards you were using, many of you said integrated reporting, and I'm pleased to say that the integrated reporting framework and its staff were consolidated into the IFRS Foundation and the ISSB's work. So the integrated reporting framework is a complementary tool that can be used with IFRS S1 and S2. So those of you using the integrated reporting framework already will find that you'll be quite familiar with the ISSB standards when you read them. And the integrated reporting framework can continue to be used to support this more holistic view of the value creation process and a more complete picture of how value is created over time. So if you're interested, please do have a look at the little guide that we see on the left of the screen there, the transition to integrated reporting, which will show you how to use integrated reporting to support your disclosures according to ISSB standards. There's a dedicated FAQ, a mapping tool, and a getting started guide. But perhaps the most important thing about integrated reporting is that it's underpinned by integrated thinking and can therefore greatly enhance the quality of a company's corporate governance. We're just going to do another Zoom poll now, and in this Zoom we ask you, my disclosure objectives should consider, and you can only choose one answer here. The ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above. I'll give you a moment to think about that.
Sorry, Lois, you're muted.
Oh, sorry, Fiona. Yes. Yes, I'm sorry to end the poll so quickly, but in the interest of time, I'm sharing the results now, and you can see most of you have got this completely right. You consider the ISSB standards, regulatory requirements, of course, and other sources of guidance when considering your disclosure objectives. So well done to all of you. And I'm handing over to Fiona now for a Module 2 summary.
Great, thank you, Lois. And as you say, that brings us up to the end of our second module. And just as a quick reminder, as I mentioned at the start, Module 2 was where a lot of our content sat. So we're well more than halfway through the training agenda now, but I hope you'll agree this has been a useful one to really run through the core content of what we're talking about. So just taking a moment now to remind ourselves of some of what we've covered. So firstly, we talked through all of those 4 core content areas of the ISSB standards. So that's governance, strategy, risk management, and metrics and targets. But of course, an important thing to remember here is that these are not operating in silos. And we saw in those example disclosures that we looked at that while there might be 4 separate categories of disclosure, of course, this information is all interconnected. And we also discussed then how your disclosure might go beyond the requirements of S1 and S2, for example, to meet the needs of different stakeholders or perhaps regulatory requirements or different industry standards as well. And so what's important to remember when you're doing this is that the ISSB standards have really been developed to act as a baseline. And that building blocks approach allows report preparers to add additional disclosures on top where they might need to do so for different reasons. But when we're adding disclosures on top of that baseline, it is important that we make sure not to obscure the requirements of S1 and S2 at the same time. Okay, so to wrap us up on this module, we'll be going back and doing another quick exercise together just to get, again, a little reflection on what we've heard so far and to help inform that disclosure plan that you may be starting to think about developing. And in this exercise, we'd like to take a moment to reflect on your key gaps. And so, of course, a key part of understanding these standards will be to take this away and to do a more thorough gap analysis. And that's something our disclosure plan is designed to help you with. But to get us started, we thought it would be helpful just to reflect on what your immediate thoughts are right now about any gaps you might have. And these could be gaps in particular types of reporting content. So maybe if you're already doing some reporting, you might want to think about different things you're going to need to add to meet the ISSB standards, maybe new topics or new areas of disclosure. Or perhaps, as well as or instead of that, you might want to also think about any process changes that you might need to make in your organization. So either if you're reporting already and you think you might need to increase the maturity of your reporting processes to improve in alignment with these standards, or maybe if you're just getting started with reporting itself and you don't have disclosures yet, the processes would be the first thing to try and address before you start preparing your information. So of course there might be many different gaps you're thinking of, but feel free to just share what might be front of mind for you as some key gaps that you've come to mind for you in your organization versus what we've talked about to date. So I'll share my screen to the Menti again, and the link to it is in the chat that I've shared with you there. And we'll take a moment just to see what's coming to mind for everyone as the sort of key gaps. So we run these sessions all over the world, and I know we hear many different things across different markets, but I think, for example, some of the things that I know are often a topic here would be data management, for example. So whilst maybe some companies have already got narrative disclosures, of course, to really understand and disclose this information about the risks and opportunities, that may require a lot more data than you've been collecting in the past. So data is often an issue that many talk about. And other things that come up will often be thinking about connecting this to financial reporting, for example, as well. So even if companies maybe have had done some sustainability reporting already, often it isn't well connected to their financial information and their strategic processes. And so that's something that they need to address. So just a couple of thoughts there. Maybe those things you agree with. So feel free to just post a message if you'd agree that those are gaps that you would have, but welcome your thoughts on any areas that you particularly want to focus on improving or getting started with in your reporting. Everyone's feeling a little shy at the moment, but I'm sure there are some gaps. So I'll give you a moment just to share anything that comes to mind, even if it's just a word or two. It's always good to know what's on your mind and to take a moment to reflect on that. Great, thank you to our plucky first respondent there. So someone's mentioned a lack of alignment with global standards. So maybe you have disclosures, but you're not aligning them with these frameworks. So indeed, that's obviously what we're hoping some of the tools that we've talked about today can support you with, is to think about what might be missing there to help you develop your reporting aligned to those standards. So indeed, keeping that investor or perhaps regulator audience in mind as you're developing that. Great, thank you for those who are sharing. So someone else has mentioned data and governance. Yeah, indeed, governance we didn't talk about as a gap yet, but often indeed for many organizations that's the case. So perhaps there's some level of accountability at a leadership level for sustainability, but perhaps the processes haven't been fully fleshed out to the level that would be needed to have the right controls around reporting as we're moving towards more standardization and auditability of information. So yes, setting out that governance is often something that we'd recommend is prioritized early in the process to give you the right foundations to build out from. Some people are mentioning metrics and targets as well, definitely, in non-compliant environments. Yeah, so maybe if it's not a regulated issue, you may not have necessarily felt the need to collect or target improvement on something to date. And so thinking about, what the material issues are that might go beyond just those that regulators want to know about, but also where the most risks lie or where investors are interested as well, can help you to prioritize where you need to start to develop more metrics and targets as well. Some people are mentioning emissions and carbon emissions in particular, often a tricky topic for many organizations to get to grips with, of course, particularly when you're starting to think about Scope 3 data in your value chain. We talked, I think, and we'll talk a bit more about some of the tools that you can use to support you in building that out, but indeed often a challenging exercise when we may not have all of that information within our own organizations. See process gaps and governance coming up again. Someone's mentioning around fair value measurement methods as well, and assumptions that need clearer documentation. So disclosures lack detail on vesting conditions, forfeitures, and valuation inputs, expense recognition not always aligned. Great, so getting into some of the core, some of the financial statement aspects here. So indeed thinking about how you can connect those types of disclosures with any information you have about sustainability risks, and how you're disclosing any assumptions here is often, something that many organizations are still getting to grips with. So I think a good point to highlight. Great. Okay, thank you everyone for sharing those thoughts. I think those align, as I said, with a lot of the gaps that we hear globally. And I think some of the things we'd encourage you to think about at this stage will also be thinking about maybe how you integrate this information into your existing financial report. So perhaps it's not something you report on at the moment, or maybe if you've done sustainability reporting, it's on a standalone basis. So often thinking about how you embed the material information into the annual report is a new aspect as well. But overall, as we said, we'd really encourage you to take away this exercise and to do it within your organization. So we'll share the link to our gap analysis checklist for the ISSB standards, which hopefully can support you with this. And as I said, the disclosure plan homework exercise as well is also designed to support you there. So really encourage you to take forward that thinking and start to try and prioritize which of those issues you address, because of course there will be many gaps, and that's totally natural. And you're not necessarily going to be able to address every gap in one go, but just thinking about which ones are really key to get right at the foundational stage, and then perhaps which ones you can prioritize for later and evolve over time as well. Excellent. Okay, so let me take us back into the slides, and then I think I'm handing over to Lois now, who'll get us started in the implement module.
Yes, thank you, Fiona. So we've looked at the content required for disclosure, and of course the standards very much focus on what to report. But the question we hear from many people is how. So we're going to have a look a bit more at the processes and practices that can help with how to disclose. So there are three parts to this module. First is about how to identify sustainability related risks and opportunities and the information you report about them. The second part Fiona will do is about evaluation, particularly evaluation of resilience using scenario analysis. And thirdly, we'll look at how to integrate your disclosures with your existing reporting suite. So let's look at identify first, identifying sustainability related risks and opportunities. We know that the standard asks us to report those risks and opportunities, but which? So remember, IFRS S1 asks companies to provide material information on all sustainability related risks and opportunities that could reasonably be expected to affect a company's prospects. And S2 sets out the requirements for climate related disclosures. So what do we do about risks and opportunities beyond climate? Well, S1 specifically directs companies to sources of guidance that can support the identification of risks and opportunities to disclose about other than climate risks and opportunities. So first of all, when identifying relevant risks and opportunities, a company must consider the SASB standards. Now, some of you know these are sector-specific standards. We've already heard a little about them, and they are available from the IFRS website. The company may also consider the IFRS educational material on sustainability related risks and opportunities and the disclosure of material information. That educational material is very comprehensive. It includes examples, so do have a look. You can also consider the CDSB framework application guidance, which covers a wide range of subjects, including social issues and biodiversity. You might want to refer to industry practices, perhaps issued by a trade body to which you belong, and materials of other investors-focused standard setters. So we've already seen that the integrated reporting framework might help. And then once you've decided which risks and opportunities to report on, having consulted those different forms of guidance, the same sources of guidance are used to determine what particular information to disclose. So the SASB standards, for example, do point to disclosure topics and disclosure metrics that can be used for particular sectors. In addition, when considering which information to disclose, you can refer to the GRI standards and the European Sustainability Reporting Standards. Now, you might remember the example we had earlier from CLP, where they had disclosed their circular economy and waste strategy and metrics to support it. And you remember that they had calculated their waste and pollution metrics using SASB and GRI standards. So they had done exactly what this guidance anticipates where there's no current ISSB standard. Let's have a look at an example now from a company called Ayala, which is a Philippines-based conglomerate company, and how it went about identifying its risks. Now, the first step here is that they did a communication and consultation exercise to find out from their stakeholders, both internally and externally, what what they should be taking into account when starting to identify their risks. So they did this background communication and consultation, and then went on to a 4-phase process for identifying risks. They established the context in which they operate. They took account of internal and external factors to consider how that might affect their risk management and the teams that work on it, their risk management objectives, policies, and governance structure against that contextual background. Secondly, they assess, identify, analyze, and evaluate the risks. Thirdly, they decide how to treat them based on interactions with their enterprise risk management team. What is the appropriate plan of action to address the risks in the different functional areas? And finally, they set up a monitoring and review process. And you can see from the output there that that output updates to the company's risk portfolio, periodic risk management report, and annual risk management report. So again, you can see the connectivity here between the process and what actually happens to the risk management report and practice. We'll look at another example of understanding and identifying risk, and this comes from a company called Nest. It's a company based in Finland, and it's a leading producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. So this extract comes from the climate section of their annual report, and it shows how they've used scenario analysis to help them identify risks and opportunities in 2 different scenarios over a time horizon to 2050. The first scenario is called the net zero world, where they anticipate global warming to be limited to 1.5 degrees in globally, or perhaps below 2 degrees in Europe and North America. So they've split their analysis of risk and opportunities in this scenario under 2 jurisdictions, and that's because some economies may take action at a faster pace than others. In both cases, the company anticipates opportunities from growing demand for renewable and circular solutions that they offer. And on a global basis, they see that they might be able to have opportunities from expanding into new markets and sectors. In the EU and North America, they expect their supply of renewable and circular solutions to be supported by regulation and voluntary ambitions. They also identify risks, as you can see, and these are associated with competition and the acceleration of new technologies. As well as the net zero scenario, they consider their risks and opportunities in what they call a compromised climate target scenario, where climate action is slow and warming of 2.5 to 3 degrees is expected, as you can see from the description they give. Here they expect that opportunities to come from being able to differentiate themselves from others by providing renewable and circular solutions. But of course, there are risks in this scenario that the demand for those products is constrained. As well as identifying the risks and opportunities using these scenarios, the company provides details of the indicative financial impact to the company in these different scenarios. And yet the most positive impact is in the net zero world 2050. And you might expect that because that's the scenario in which they can take advantage of the most opportunities. Now, we've talked about this already, so I won't go into it in detail, but the standards recognize, of course, that sometimes identifying risks and opportunities and what to disclose about them can be challenging. So to make sure that the effort is proportional to the benefit, the standard says that when doing so, the company is only required to use reasonable and supportable information available at the reporting date without undue cost and effort. Now, I mentioned earlier some new guidance or educational material that the ISSB has set out. That was in a link earlier. And they describe in that educational material these terms in some detail. But generally speaking, reasonable and supportable information is specific to the company. So that means that the company should know about it. It's not just general information to say something like, well, climate change is a threat to all. It is, but really what the standard is looking for is information that's specific to the company. It should take account of the external environment, and that's just what we saw in the Ayala example in the first and second phase of their risk management process. It should include information about past events and current conditions, and of course the company will already know about those and they can't ignore them, but it will also take account of forecasts, and perhaps that will include looking at scenarios just as we saw in the Nest example. And in some cases, what constitutes reasonable and supportable information is specified by ISSB standards. So we're now going back to Fiona to take us through the next part of this module.
Thanks, Lois. Great. So once we've identified those risks and opportunities, we're going to need to evaluate the financial effects of them. And we know that when we're getting started, this can often be quite a daunting aspect. So we'll try to cover a few of the key concepts to help get started here. So to help investors understand a company's resilience against climate risk, S2 requires a company to disclose information about the implications of climate change on its strategy and business model. And so it also asks for the company's financial and operational capacity to adjust over the short, medium, and long term and adapt its operations. And for example, this would be where you want to start thinking about how you could test your company's resilience. So maybe, for example, a commodities company might look to test its place against new regulations to limit high emissions activities or to respond to changing crop yields, for example. And so to do this, this is where you would need to use climate scenarios that come from science and analyze how these will lead to different effects. And it's important to remember that scenario analysis is not asking you to predict the future. It's just a tool to test your resilience against plausible possible future pathways. And overall within S2, companies are asked to use this analysis to identify relevant scenarios, provide disclosure on the assumptions that they've used, and to make a conclusion on the overall resilience. And this is again where companies are asked by ISSB to use an approach that's commensurate with their circumstances and that uses all reasonable and supportable information that's available to them at the time of reporting without undue cost or effort. So again, let's see an example here to see what this could look like. So this example comes from Nestlé, who you're probably familiar with as a multinational food and drinks company. And so here we're seeing just one output from their climate scenario analysis that comes from their 2024 reporting. So again, encourage you to look at the full report to see all the different types of analysis they've put in for this section. In this visual, they've summarized the potential impact of physical climate changes on the yield of 12 of their key agricultural commodities for 2040 under a medium carbon emissions scenario. And so this modelling then projects the percentage change in their crop yields they're expecting in 2040 compared to the baseline of 2022. And so this is showing that potential increases in heat waves, droughts, and water stress could affect the availability and quality of some of their key raw materials. And that in turn, they say, could lead to increased prices and increased input costs for their business, and possible yield reductions could also affect the overall stability of their supply chain. And so in the disclosure report alongside the visual, they go on to talk about the key outcomes of this analysis for different areas of their business. And they talk about some of the steps that they're taking in response to this to improve their resilience. So for example, they're looking into product innovation, operational efficiencies, and potential R&D initiatives that leverage crop science to improve their resilience to these potential changes in the future. And so, of course, when we're anticipating the materiality of future events, we know that can be really challenging. And so to help with this determination, the S1 standard gives you a number of issues that you should keep under consideration to help you to continue to assess any uncertainties associated with this assessment. So I'll leave this list in the handout for you to look at in more detail, but really you can think of this as a list of things that you should try to assess and disclose on a regular basis. So whilst it's inherent that there will be uncertainties, the most important thing here is that we're continually assessing these and we're being transparent in any assumptions or uncertainties that underlie our assessments. Okay, back over to you, Lois, for our next segment.
Thank you, Fiona. So this next part is about developing new processes or using your existing processes for sustainability disclosure. And the good news is that you may already have lots of processes already within the company that can be used for sustainability disclosure. Take risk management and governance, for example. You've probably already got processes you can use to support your disclosure. But here are some considerations that may apply when you're thinking about whether you can use existing systems and processes or whether you need to develop something new for your sustainability disclosure. We've talked already about gap analysis and provided a link to the Sustainable Stock Exchange Initiative gap analysis tool you can use. The next two are about the criteria that you use for sustainability related risks and opportunities and evaluating them. So sustainability characteristics are different from other risks. Of course, because they develop over longer time horizons, they are more uncertain, and therefore, when looking at your existing processes, you might want to think whether the criteria you use for assessing risks are suitable or whether you need to incorporate new criteria such as vulnerability and speed of outset. Your internal controls might be applicable to your sustainability disclosures, so they should be evaluated. And then, of course, there's people. Which departments, people within your organization or external experts have processes and systems that can help you with your sustainability disclosure? Who are they? Where are they? And what are their processes? What are the interconnections between different internal and external factors that are relevant to considering whether you have suitable processes? What uncertainties do you face, and how can those uncertainties be reflected in your processes? Will you have some sort of tolerance criteria for determining the level of uncertainty whereby you will not report something, as we saw from examples earlier? And what resources are in place to manage existing or develop new systems and processes? Do you need to go through a budget or a change management process to seek more resource to develop your systems? Now, in the homework exercise, the voluntary homework exercise that we give you, we're suggesting that when considering these and other things, a disclosure plan could be helpful. Now, a disclosure plan we think of as a standalone strategy or part of a wider disclosure strategy that helps you organize people, practices, and processes to support your disclosure. So by doing this, you can take control of your narrative. After all, the standards ask you about your risks and opportunities to your company strategy, and so on. The disclosure plan can help support internal collaboration by making a note in the plan of where there are processes, systems, knowledge, and teams that can collaborate to help to develop your sustainability disclosures. So you might think, for example, are there people in risk management, company secretarial, finance? It can help you create a reference point and, importantly, an audit trail of how your sustainability disclosures are prepared, how they relate to other disclosures, and how judgments are made, including how data will be sourced, whether you will seek assurance, what judgments have been made, what goals do you have for your communication, and what are the sign-off procedures. All of these things can be covered in a disclosure plan. Well, look at an example now, which, although not called a disclosure plan, is called a basis for preparation, tells us a lot of things which we would expect you would find in a disclosure plan. So Novo Nordisk is a big Danish pharmaceutical company, and this extract from their annual report tells us the basis on which they have prepared their sustainability statement. So in the first paragraphs, they tell us which standards, guidelines, and so on they have adopted to support their sustainability disclosure, either because they want to or because they have to. So we see quite a long list of the things they've used to support disclosure. We see how they define time horizons that they've reported to. So they tell us what they mean by short term, long term, and medium term. There's quite a lot more in this extract and elsewhere in their report about the assumptions that they've made, the uncertainties that they have, and other contextual information to help us understand the disclosures. And of course, you can imagine that trying to get this information together right at the start of the reporting year or even before that is very helpful. So you have your disclosure plan set up, and that should help you with your sustainability disclosure. So let's have a Zoom poll now, and you can only answer yes or no. Be very interested in your answers to this one. The question is is a disclosure plan required by the IFRS Sustainability Disclosure Standards? And you can answer yes, you must disclose your plan, or no, but it's a very helpful tool. Let's give you a moment to think about that. And Fiona, I think in the interest of time, we'll skip the next poll and go straight to the Module 3 summary if you agree. So let's have a look at your answers. Sorry to go through this so quickly. I'm going to share the results with you now. You can see that it's quite evenly split. Most of you saying, yes, you must disclose your plan. Some of you saying, no, but it's a very helpful tool. Well, those of you that said no are correct. There is nothing in the IFRS Sustainability Disclosure Standards that says you must have a disclosure plan and you must give details about it. And please note that there are requirements like paragraph 59 of S1 that says you must disclose the sources of guidance that you've used for creating your disclosures. Paragraph 15, you must faithfully disclose information which needs providing additional details if necessary. Paragraph 81, you must disclose assumptions and uncertainties. So there are some things that you have to disclose about your basis for preparation. There's no need to have a disclosure plan, but we recommend it because we think it's a very helpful tool to support your reporting. So over to you, Fiona, for the Module 3 summary.
Great. Thank you, Lois. And yeah, I fully agree with you there. So I hope many will consider looking into developing a disclosure plan after this. So to wrap us up, we're just going to remind ourselves of a few key things we've covered in this module. And so firstly, starting with connections. So last time in Module 2, we wrapped up highlighting the importance of connections between those 4 core content areas of disclosure. And then here in the implement module, we learned that there are, of course, many connections as well between a company and its external and internal environment. And really, these connections are what we need to focus on when we're identifying key risks and opportunities. And then the second thing that we talked about here was relating to evaluating those risks and opportunities. And a key component of that evaluation is consistency in your assumptions. And so here is where using scenario analysis can be a very helpful tool because it's going to allow you to do that assessment of your resilience, and it's a way to also keep track of those assumptions. And finally, as we've seen, even if for some of this data, it's not something you're necessarily currently collecting or disclosing, it may well be that you have processes already in place or practices that could help you to start to collect this information. Or perhaps if you talk to your colleagues and look around your business, you'll find that that data might actually be kept or collected somewhere already for other purposes. So as much as you can, you should be aiming to build on that and not start from scratch with your reporting. Okay, so again, to wrap us up on this exercise, we're going to have a little Menti reflection point, thinking really here about processes and systems. So we talked there about actually there might be ways that you can access data that will help you here. Excuse me, I'll just go back one slide. And this is where we want to reflect either on you if you're a report preparer or if you're working with others in your organization or with other organizations thinking about this topic, how you could work with them on this. So of course, as we've said here, there's a few different things you'll want to consider. So you've heard perhaps through the new standards we've talked about now that there might be different types of data that you'll need to collect here. And also that you might need to manage how you collect data a little bit differently to maybe how you have done in the past. And fundamentally as well, you might need to start thinking about how you can integrate the sustainability considerations into your wider organizational processes. So if we're looking for a sort of parity in data quality and controls between our financial accounting and our sustainability reporting, we might want to start to think about how we can connect those processes together. So yeah, as I said, we'll go into Menti now to have a little reflection on this point. And so the question really for you is just to have a little immediate reflection on maybe front of mind for you are some existing data processes that you have that you could make use of. Maybe you have new processes that you think should be adapted or developed to help you here. And maybe you just have some thoughts on what data you already know about within your organization or the organizations you're working with that can support these understanding of sustainability areas. Okay, so some responses already here. Thank you. Thanks for our respondent from Telesom who's giving some excellent context from your organization. So you've mentioned that you're adapting existing processes to collect sustainability data. So you have your HR tracking sustainability training and employee engagement. You're using your ISO management systems, which allow you to monitor energy, water, waste, safety, and finances. Yes, that's great. So as you say, your colleagues in different functions may well already be tracking this sorts of information for their own purposes. So if you can access what they're already collating for your reporting and assessment purposes, that's fantastic. And indeed, the ISO management standards provide a great structure for internally managing these topics and will have indeed required you for continual improvement purposes to be tracking a lot of these topics. So again, thinking about how you could repurpose that information for disclosure is great. Someone has mentioned as well another area being around maybe requesting product carbon footprints, and I presume you're referring there to requesting those from your suppliers. So absolutely, yeah, if you're sourcing products and you can obtain that sort of information as part of the procurement process, that will be a really helpful input to assessing your scope 3 emissions from purchased goods and services, definitely. So someone else has mentioned looking at their existing processes such as financial reporting and risk management, compliance, and maybe their HR data systems as well. So some similarities to our first respondent, but I think talking about finance and risk management is really a good point to bring into this as well. Indeed, your enterprise risk assessment process is likely to currently consider many related topics to sustainability risks and opportunities. So looking to your colleagues in risk and finance as to what has already been gathered as part of the ERM process, or maybe whether that risk process could be further developed to better support you on sustainability risks and opportunities is a very good idea too. Someone else is mentioning maybe desk reviewing your policies, yeah, to see what maybe they say on some of these topics and where that could inform further action. And indeed, if you've already done internal audits or you can do internal audits and compliance checks, probably lots of the findings and recommendations from those will be relevant here, or just offering a good compendium of data sources that have been collected and audited. Administrative and operational data and financial systems, exactly. So a lot of that operational activity information is very important to helping you understand maybe the sustainability effect of those activities. So as we've talked about already, maybe that's water energy usage, maybe it's more to do with people and how people are operating within your business as well. And indeed within your financial systems. So thinking about connecting between those financial systems and how you can use that for sustainability reporting is a good suggestion. Perfect. Well, thanks for those thoughts. I think in the interest of time, we'll wrap up here. And I think you've mentioned already several things we'd highlight. But another thing maybe just to reiterate here is around making sure that you have those right governance processes in place to help you here. So thinking about actually how you have different information flowing through your governance processes already and what your colleagues are collating and reporting for management could also be something that you could access for external reporting processes. Great. Okay, so that brings us up to starting off with our module 4 on communications, which I'll hand over to Vanessa for. So I'll just give you the access to the slides again now, Vanessa.
Okay, thank you, Fiona. So everyone, we are now moving on to the final unit of this training, which focuses on the when and where of disclosure of sustainability-related financial information. As with the last unit, we have 3 main sessions. To get us started, we will look at the location. In this session, we are looking to clarify where sustainability disclosures should be located. Before we dive into the specific requirements, let's think about sustainability disclosures in the context of a complete reporting package that is useful to investors. Investors already have access to a company's financial statements. ISSB standards are designed to identify sustainability-related risks and opportunities that complement the financial statements. These are This all come together in a reporting package that we call a general purpose financial report. The requirements in the ISSB standards about what information to report are based on existing sustainability reporting regimes, focuses on investor information needs and on experts of financial accounting standards. GRI standards expand on sustainability metrics relevant to broader social concerns. ISSB and GRI's reporting standards share some content requirements, such as what to report. However, the ISSB standards are focused only on investors' information needs and decision making, reflecting the mission of the IFRS Foundation which is to bring transparency, accountability, and efficiency to capital markets around the world. Both organizations take different approaches to define materiality, but they are not competing. The GI approach is set out and understood among sustainability practitioners, whereas the IFRS approach is familiar to accountants and relies heavily on management judgments, which is we align with existing corporate risk management process. Therefore, together, those two frameworks enable companies to meet the growing demand for transparent, consistent information across financial and non-financial dimensions, aligning both investor priorities and broader social concerns. A simple example is where double materiality assessment identifies that some of the company's impacts may also create sustainability risks, which could be so significant that they are important to disclose to the investors. As we just noticed, materiality has different definitions for different reporting standards and audience. So let's briefly recap what we mean by material information for the IFRS. In identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. Once the company has identified those risks and opportunities, it can then determine what information to provide about those risks and opportunities. That is where our materiality definition comes into play. The definition of material information used in S1 is based on and aligned with definition found in the IFRS accounting standards. It is information that, if omitted, misstated, or skewed by other information, could reasonably be expected to influence investor decisions. In other words, the ISSB standards seek to identify disclosure of key information that matters to the investors. An entity determines what constitutes a sustainability-related risk or opportunity based on its facts and circumstances. Entities often have well-established process for identifying, assessing, and responding to sustainability-related risk and opportunities as part of their management of their process. We have experienced investors have asked for disclosures for material information, and the ISSB standards have been designed to help you gather and disclose it. However, this means that a company does not need to disclose information that is not material, even if the ISSB standards include it as a specific requirements. There were a few things to remember. Firstly, ensure material information is clearly identifiable and that you can use plain language. And secondly, ensure the material information is not scattered across your disclosure. And thirdly, include any additional or non-material disclosures if required by the regulators, but ensure it is clearly identified as such. So in November 2024, IFRS has also released further education material providing guidance for companies on identifying and disclosing material information on sustainability-related risks and opportunities, which we will encourage you to take a further look. So now let's take a pause here and let's have another Zoom poll to test your understanding of what kind of information that ISSB standards should be applied for. Let me give you 1 minute for you to start. Yeah, for the interest of time, I'm going to stop here, but I can see like the going trend to select A and B. So the correct answer should be A and B. And for the option C, unless it has been determined by that the particular values being exemplified are expected to have a financial effect on the company, this may not be the information that is necessary. Okay, let's continue. Let's continue to talk about where to report. So we know that disclosure under the IFRS standards has to accompany the financial statements and be part of the same general purpose financial reporting package. However, IFRS S1 does not say where in that reporting package that information should be provided. This is designed to allow jurisdiction-specific requirements on the location of reporting. The most important factor to consider here is to ensure that sustainability disclosures are provided as part of the same reporting package as the company's financial statements. Sustainability disclosures must be provided at the same time as the related financial statements, cover the same reporting period and as the financial statements, and authorized by the same body or individual authorizing the financial statements. There is a research by WBCSD on the states of integrated reporting shows that nearly 2/3 of companies continue to put sustainability information in standalone reports. However, ISSB standards require material sustainability-related financial disclosures should be included with the general purpose financial reports. This suggests that many companies have some way to get their internal process and disclosure plans aligned. Now let me hand over to Louis to bring us the example.
Thank you, Vanessa. And this example is from Ayala, which is the Philippines-based corporation that we saw earlier. And it's about integrating the sustainability information where you're using multiple frameworks and you have multiple requirements. So this, I know many of you are using integrated reporting, and you might recognize that this model on the screen is based on the integrated reporting framework, where we see the input of capitals to the value creation framework and the value generated. But the main point of showing you this this particular extract is about how the company has organized information to help the readers navigate it. So not only can the reader see how information is presented because it is relevant to the value creation model, but they can also see the page numbers where they'll find information. So you can see in the orange circle in the middle, we see the page numbers where outlook, material topics, risks and opportunities, business activities are set out. And these titles relate to the integrated reporting framework, and we find the page numbers where the information is. The other thing to note about this one is that they're using little icons. So you can see in the right-hand column under focused execution, there's a little picture of a transparent skull with a cog inside it. And that relates to the middle circle where you see the vision pillar. And this is to show us that we have a disclosure that is about strategy, about execution of the strategy and the company's vision. So use of an integrated reporting model, use of a focus on value creation, page numbers and icons to help organize information in a report. Back to you, Vanessa.
Thank you. As Louis just mentioned, like the technology. So let's take a further look. The technology is an emerging consideration for tech disclosures. Increasingly, corporate reporting is moving from PDF reports towards information on web pages with structured data sets, such as those databases offered by the stock exchanges. The IFRS Foundation has created the ISSB taxonomy, which reflects the requirements and accompanying materials of the ISSB standards. So the taxonomy does not introduce any new requirements. A digital taxonomy provides the common elements or tags needed to make your sustainability disclosures machine readable. This makes it easier to take large data sets, like information from an entire industry, and bring them all together to analyze them. There are a number of benefits regarding the digital reporting. Firstly, it can make the reported information easier to use for analysis. The data is structured the same across the business in a machine-readable format. And secondly, tagging information potentially allows for automated checks for quality and consistency. And thirdly, more and more data connection and management systems are compatible with digital reporting taxonomies, improving processing and reporting and report preparation. And lastly, text can have labels and descriptions in multiple languages. If you report your quantitative data in one language, someone speaking another language can also understand what it means. So following the discussion on the location and the timing, let's now think about ensuring the efficiency, the disclosures efficiency. We have added this into our training because there was like a comment we found from the corporates is that there is a growing reporting burden. What we hope to highlight here is when done correctly, efficiencies can be made to reduce the burden. First of all, it's important to understand what effective communication looks like and what it is required. Often, companies think that if they just put all the information they have into in a report, that everyone will be satisfied. However, this will not be the case, and it will be against the core concepts, in particular fair presentation. For example, it could be helpful to ask these questions. Firstly, is the information clear and concise? Clear might depend on the nature of the information. For example, whether it could be clear to present information in tables, graphs, diagrams, or complying text. And concise means like to be concise. These disclosures needed to avoid boilerplate information, unnecessary duplication of information, and to use clear language. And next, let's talk about the quality of information disclosed. Some players watching today might be thinking to themselves like they don't see what all the fuss is about, and perhaps their experience focuses on standard non-sustainability reports, or they haven't had much interaction with external audit. To the accountants watching today, I say to be kind to your colleagues. Help them understand the difference in the rigor and that's required in data collection, oversight, sign-off for financial statements. So this means, for example, disclosures include comparative information and are to be restated as necessary. And secondly, disclosures avoid unnecessary duplication and cross-reference as required. And thirdly, information has to be materially be connected and aggregated or disaggregated appropriately. As you may have already noticed, there may appear to be some overlap in the disclosure topics. For example, you might have the same governance approach for all sustainability issues. Rather than duplicate certain information, you can use cross-referencing to enhance efficiency of your disclosures. Cross-referencing to other reports is permitted as long as the other report is available on the same terms and at the same time as the sustainability disclosures. The cross-referenced information is assumed to become part of the reporting package, and the cross-referencing shall be applied consistently and transparently. It shall not result in the information becoming more difficult to understand. And now let me hand over to Louis for the example.
Thank you, Vanessa. And yes, this is an example of cross-referencing taken from the report of ArcelorMittal, which is a big multinational steel company. And here ArcelorMittal mapped the areas of their 2024 reporting outputs that address the core content elements and concepts in IFRS S1. So this helps report users to navigate and locate information. So in the left-hand column, you can see content elements and concepts with which you're now familiar from our presentation today. So we've covered things like governance, business model, risks and opportunities, and strategy. So we know that they are providing information in response to the content requirements in the ISSB standards. And then on the right-hand side, you can see where they cross-refer the reader to where they can find information. So sometimes the information is in the same report, in the sustainability report. So with governance, you can see they say you can find it under the title Governance and Risk Management in our sustainability report. Under risks and opportunities and strategy and resource allocation, for example, they refer us to their annual report and their 20F, which is a US registration document. So cross-referring within the report and to external reports by reference to the ISSB content elements. Thanks, Vanessa, back to you.
Thank you. And we have sought to apply a number of mechanisms to support preparers get started with this ISSB standards. One simple thing put in place was to adopt well-known terminology and concepts familiar to preparers, borrowing from IASB, for example. And then many requirements in S1 and S2 are to be applied proportionately, recognizing companies will have a range of capabilities and preparers on these issues. For example, qualitative scenario analysis is permitted, and you will see the phrase all reasonable and supported information at the reporting dates without undue cost and effort or consumerate with skills, capabilities, and resources in a number of places. And thirdly, reliefs for the first year of application have also been introduced and include such as companies being able to limit disclosures to climate in year one and begin reporting on their other sustainability risks and opportunities in year two. And secondly, companies being able to provide annual sustainability related financial disclosures with their next half year reporting rather than at the same time as the financial statements. And thirdly, companies not needing to provide disclosures about Scope 3 GHG emissions apply the GHG Protocol corporate standard to measure emissions if they are already using a different measurement approach or provide comparative information in the first year of reporting using S1 and S2. Another relief allows company to include GHG emissions information obtained from other companies in the value chain with a deep fund reporting cycle. And also, we have already mentioned a number of other resources of guidance and including SASB standards, CDSB framework, and application guidance, among many others. The above all those releases are designed to enable companies to put in place reporting practices and structures to provide high quality, decision useful information. And the jurisdictions will decide when to mandate those adoption, but the standards are effective from January the 1st, 2024, and we know many companies are now preparing to adopt them voluntarily. And now let's take another sample here to test your understanding of the disclosed information that we refer to the ISSB standards. Yeah, let's just take a few seconds to stop here for the interest of time. Yeah. Okay, let's stop here. Okay. Yes, the correct answer should be all include, however, C is not included. So the correct answer is A, B, and D. So the information you need to disclose like decision useful, material, and comparable. And let's quickly jump to the next sample to test your understanding of the useful information that we that we refer to. It's another a few seconds. Yeah, for the interest of time, just stop here. Yeah, the correct answer should be all. I can see like the green trend for all of the options. And now let's finally, we are moving on to the final session of our units. On our final session of units, we will be looking at how you can ensure that the users of financial reports have confidence in the data you are disclosing, as trust is an essential component of sustainability-related disclosures, and increasingly so with the growing concern over the greenwashing. An important trust builder is showing data and trends over time. This is why ISSB standards asks for comparative information. So comparative information provides context, helps to indicate progress and underpins strategy and risk management. And secondly, metrics disclosed by a company might be redefined or replaced over time, or the company might change its methods for estimating on a metric. In these situations, it is important for the company to revise the comparatives to enable investors to compare and analyze current period figures with the relevant prior period figures. Occasionally, a company's sustainability disclosures might contain material errors. In this situation, the company is required to restate these errors in the comparatives provided. And fourthly, revisions or restatements are necessary only when there is risk that material information being omitted, misstated, or obscured as a result of not revising or restating the comparatives. And information can be qualitative and quantitative. We know that like companies sometimes will express concerns with sharing information when they deem to be sensitive, or they think with the share the share of information will delete their competitive advantage. At the ISSB standards relieve a company from disclosing information about a sustainability related opportunity if that information is commercially sensitive. If there is a concern you might have, there is a further detail you can read in the handouts. And finally, it's important to build confidence. It's important to build confidence by providing clear statement of compliance. A company that complies with all requirements within the ISSB standards, even the reliefs, is required to make an explicit statement of compliance. We have also published further guidance on this in September 2024, called Voluntarily Applying ISSB Standards, a guide for preparers. Before I hand over to the summary of the module, there are still things to remember. Firstly, walk through the list. And secondly, you can find in the handouts a slide deck, an additional slide in this session with reminders of how to report effectively. And I highly you guys to take a further look. And now let me hand over to Fiona for the summary.
Thanks so much for that, Vanessa. And that brings us up to the end there of our final module, as we say. So I'll be doing a bit of a wrap up now on this module and on the course more generally as well. So stay with us for this final section. So firstly, wrapping up on this concepts we've covered in this module. So firstly, we discussed where to report information. And what was really important here was thinking about the audience and who you're reporting to. So making sure to be clear at outset who the primary user of this information is will help you ensure that this information is the right information for their needs. And then we discussed efficiency. And I think a key takeaway here really would be that less is more. So the objective is not to overload your investors with information, because actually that could be harmful in of itself. It could obscure the information that's required or that's deemed to be most material. But really, this is where using the standards here as you get started is going to be a good guide, because it's going to make sure you're providing that information that investors really need, which of course is the overall purpose of the standards. And then finally, we talked about report user confidence. And especially in the current climate of greenwashing and possible legal implications from public statements, of course, you need to ensure that your data is not only accurate, but that you're presenting it in a way that builds confidence among report users and is transparent and balanced. So this is where the disclosure plan that we've been discussing throughout the training today, which is an optional thing to have, but something we really recommend because it can help you to do this. Because if you do it well, you're going to have a clear and documented approach through the disclosure plan for reporting that data that investors need and doing so in a balanced way. Okay, so to wrap us up on this final module, a quick last exercise, just to think about some of those ideas we discussed there regarding how to communicate your information in the best way. So we talked there about some options regarding how to integrate information into your reporting and to make it more navigable. So maybe you can just let us know which of those techniques do you think will be most effective, maybe which ones are you already using, or which ones would you plan to put in place? So I'll give a moment for everyone just to share their thoughts there. And if I could ask my colleague just to reshare the Menti link a final time as well, that would be great, just to make sure everyone can access this. Let me just move that question on there. So that should now show you the right question relating to this concept about reporting techniques. So yeah, maybe these are techniques that you're using already. Maybe they're ones that you would start doing as you're reporting. But what do you think is most helpful to make the reports easy to navigate and to understand for your audience? Just give us a moment for a couple of ideas to come in. Someone's mentioned there around using infographics and hyperlinks. Absolutely. So I think in a couple of those disclosure examples that we've seen today, infographics are used quite effectively to summarize and convey key concepts, and even hyperlinking then content from that infographic, I think as Ayala may have done in their example, is great. So maybe integrating information and using executive summaries as well, as someone said. And I know we've had a question in the chat, or sorry, the Q&A, which is being answered around that balance between aggregation and disaggregation of information. And of course, it's just finding that balance of ensuring you summarize and have concise information, whilst also making sure that that detail is there where it needs to be as well. Great. So just a couple of things I suppose that we would recommend and mention here was, we've already talked about a few of them, would be making sure that you've got a clear table of contents in your reporting, ideally with hyperlinks included, that you use clear headings in your report, and you try to align the titles and wording in those headings to those that come from the standards so that your investors will recognize what information they're looking at. Using a navigation panel on the side of your report can also be helpful, as we've seen in a few of the examples, so people can quickly click between the different sections and understand where they are in your disclosure. And then finally, thinking about digital reporting, as Vanessa introduced us to there. So beyond just having a PDF with links, are you thinking about maximizing digital technologies, both in terms of reporting technologies, but perhaps online reporting options as well that help make that content navigable and interactive? And a few more answers just coming through there regarding using indices as well, and having good sciences and methodologies and clear hierarchies. So thanks everyone for those thoughts. I think all of those are indeed great suggestions. Okay, so that will just close us off now with one final Menti question that we wanted to ask you, which is just to get a sense of where we think we are now against those tasks that we started out with today at the beginning of the session. So I'm hoping that we'll feel a little bit more comfortable now from where we started with some of the concepts around the ISSB. So take a moment and just let us know your thoughts on where you're at now. Oh, I see a great response from our first person who's now up at 5 on everything. So excellent. I'm really glad to hear that. But of course, we know that's not the case for everyone. It depends where you started. So we hope if you're feeling at least a little bit more comfortable than you were at the beginning of the session, and you have an idea where you can go for more supported information, that will be helpful as well. Great. I'll leave you to respond to that in the background, and I'll just take us back to the presentation now for our wrap-up slide, where we're going to be talking about a few of the resources that we can use, and also talking about that all-important element around your completion certificates. I'll just move on. Unfortunately, we were hoping to have a closing from the ISSB today, but our colleague is having some internet connection issues in her location, so has been unable to join us. Yeah, so just from our side, a few things again to bring back up. So we've talked a number of times throughout this session regarding the homework assignment. And as a quick reminder, this activity is entirely optional. It's just for you to do if you'd find it beneficial to and to continue the learning that you've started today. So you'll find the link to access the homework exercise in the resources section of the event webpage, which we've shared with you a number of times during the session today, and no doubt Lois will share it another further time with you for good measure. So the homework exercise follows that same structure as those 4 Menti exercises we've used in today's session, and really takes you through considering those 4 steps of prepare, align, implement, and communicate to build out that disclosure plan. So if you follow the structure of the disclosure plan, hopefully that should enable you to develop the plan for your company and to put into practice what we've learned today in the training. So really encourage you to take that away and have a look at with your colleagues to help you continue this within your organisations. And also, just to close, we'd like to help with identifying a few resources that you can refer to give you some more support on this topic. So firstly, make sure to use the IFRS Sustainability Knowledge Hub. This is regularly updated with new resources and guidance, including all of those new educational materials we've referred to throughout the session. And in June, the IFRS also launched a number of free e-learning modules to support adoption of the ISSB standards as well. So these are self-paced, interactive knowledge checks, and also include CPD accredited certificates too. So a great way to continue to strengthen your practical understanding of the ISSB standards, and also to share with your colleagues as well. So I encourage you to check that out. We'll also highlight the resources of the IFC, a key contributor to this programme. The IFC's Beyond the Balance Sheet programme is a really great suite of resources, guidance, training, and other forms of support that can really support you in implementing topics relating to sustainability and climate, with a particular focus on emerging markets. So if you refer in the slide handout, you'll see there the QR code to access these materials, and I can see Lois has reshared that again in the chat for us, so thank you, Lois. And another reminder, we mentioned this at the start, but we also have the SSE's toolkit of resources if that wasn't enough. So SSE is working closely with the IFRS and other supporting partners to really help advance this topic with exchanges and with the issuers. So this new toolkit really provides you with a guide for your markets on the ISSB standard, and it includes today's training, of course, but also a number of resources, including our model guidance. And particularly, I would also like to highlight our gap analysis checklist there for sustainability disclosures. So that's quite a practical tool you can help use to structure and understand those gaps that you might have and how to address them. Okay, so a big well done and thank you to everyone who's still here with us after our 3.5 hours of training together. We do know that this is a long time to be online in the online environment, and there's a lot for us to cover. So we're really appreciative for all of you who've asked questions and engaged with us throughout the session. And as a thank you for that hard work, you're now able to receive your completion certificate. So to do this, you're going to need to fill out the feedback survey, which Lois has just shared the link to in the chat with you now. So if you follow that link and complete the survey, we'll then send you your certificate within about a week of having completed it. Another option, if you missed that link in the chat for any reason, is that if you attended live with us today, you'll also be sent an automated email from Zoom within the next 24 hours that will reshare that link with you again. So once again, if you take part in that survey, let us know your thoughts and feedback as well, which we always love to have, and then you'll receive your completion certificate in a week. A few quick pointers on that. We send out our certificates through an automated system. So make sure to check your junk folder if you haven't received your certificate, because sometimes we know they can get caught there. And indeed, if you know your company has a particularly strong filtering policies for email, maybe complete the certificate survey using a personal email address, like a Gmail account, for example, as usually they have a better success rate at getting the surveys through. Okay, so just before we close out, a few final words of appreciation. Firstly, a big thank you to all of the SSE supporters, a group of stock exchanges and other organisations who are really supporting our work and continuing to make this programme possible. And a big thank you again to the supporting organisations for today's session. Firstly, a big thank you to the Somali Stock Exchange and Hamdi and team for your kind support and hosting for today's session. Thank you, of course, to our partners at the IFC and the IFRS Foundation, and in particular to Robert and Vanessa for supporting us with today's training and answering all of your questions. And again, a big final thank you from us at the SSE team to all of you who've joined us here in the training. We really hope you've enjoyed the session and that it's been beneficial for you. Look forward to hopefully seeing you again in a future training, but wishing you a great end of your day and hope to see you again soon.
Fiona?
Hi there, Robert.
Hi. We have Nadidi, our board member, online. I think Nadidi, can you hear us?
Yes, indeed, I can.
Oh, hello, Nadidi. Thank you for joining us. So great that you're able to be here. So we just have a few closing minutes. So if everyone's happy to stay on, I think that would be great to hear from you. So as I mentioned to everyone, Ndidi is a member of the ISSB board. And a great representative of Africa, I guess, as a continent, which I know is a big region, but wanted to join us to say a few words from your perspective. So many thanks, Ndidi, and I'll leave you just to close out the session in our final 2 minutes that we have now.
Yes, and I'll be extremely brief. I think the most important thing was just to be here and to extend, like you've just done, our thanks to the various partners that we've worked with, especially the Somali Stock Exchange, and to say that we would very much welcome further engagement. We hope the session has been, I'm just seeing a message that says it's been a brilliant workshop. I think the thing to add, which I'm not going to do with slides right now, is to remind you that there's an exposure draft out there on the industry specific standards, and that there's a huge opportunity actually to weigh in with a Somali perspective on the metrics that are relevant in your particular region for the 9 standard industry specific standards that are out there. But otherwise, just great. I can see from the hearts from when I joined how exciting the session has been. And I hope there'll be another one very soon.
Great, thank you so much for joining us. Indeed, I'm glad you could make it in the end. I know that was a little challenging, so appreciate you making that work for us. Brilliant. Well, thank you. I think that's a great way to close out the session. So as we said, wishing you all the very best of your day, and we'll hope to see you again at a future training. So many thanks, everyone, and take care.